Get their higher revenue from? Is it from volume? Is it from mix? And previously they've been sacrificing volume to push up those prices, and they've had to do that because their costs were going higher and they felt that they needed to pass those on to consumer. They see reduced need to do that now. So this is going to be interesting, the way that the pricing dynamic develops as we get towards the start of as we get to focus in on some of these earnings stories. European markets are open. We are open across European stocks then. So we have this futures picture that has been suggesting that we'll get some weakness everywhere apart from the London market. London markets were expected to go higher. We'll see how that plays out. And we see an early pop to the upside then on the FTSE 100, up by just 0.1% just there.
And in the early shakeout, even you look at some of these European stocks, yes, we're still getting initial reads on them, but it is a little bit of a turnaround from the trade that you saw yesterday. Remember, one of the big heavy hitters on the Stock 600 were a lot of these kind of tech names, for example, ASML with that fat finger trade, SAP following on par. It looks like it's actually flipped this morning in terms of the initial read. We are still, again, waiting for a lot of these numbers to come out. It is only 8 o'clock. But that being said, when you do look at the UK numbers as well, it's a similar story. Remember, commodities outperformed yesterday. Today, they seem to be a bit of a wait. But Anna, I want to come back to that point that you made on Heineken. This believability story is so important. When you look at the Euro Stoxx 50, for example, and it is still, by the way, our top movers this morning, still kind of populating again as we get those initial holds. It's not really a sectoral story. GSK, for example, your top mover, higher by 1.7%. You got a little bit of banking in there. Some of your underperformers, however, are going to be those consumer brands. Interesting that luxury is actually lagging. How much of that are we going to see still kind of shake out as we talk about, again, perhaps a reversal of the trade we saw not just yesterday, but in the last 10 days or so?
Yeah, just looking at the broad gainers and losers then. In terms of the upside, personal consumer discretionary, grocery stores, all moving higher. And it's the latter part of that then, Chrissy, that is moving higher this morning. Our whole Delhaize up by just over 6%, in fact, and that seems to be lifting sentiment within that sector. It is by far and away the best performing sector this morning. The media space not doing too badly as well. The likes of WPP just gaining 1% or so. To the downside then, food, beverage and tobacco is the weakest, and we see a focus there on the brewing space. So Heineken down by 6.5%, Anheuser-Busch InBev, AB InBev down by 3.4%. So that's where the weakness is coming in.
How much of that is a read-through from the Heineken story as well, to your point, as opposed to kind of its own fundamental dynamics? I think I don't usually look at Heineken as kind of that macro indicator, but maybe it is simply because of that resilient story, that divergence that you're seeing between Asia and the Americas. So many of the corporate stories that we've heard coming out of Europe, even in the luxury space, has talked about this American resilience offsetting some of the weakness that you're seeing in Asia. Heineken putting it kind of weakness across the board. But again, it's that buyback picture that continues to distort the markets. ABN AMRO, again, disappointing on those buybacks at a time when you kind of need those to really hold on to some of those investors.
And I know that buybacks is something that you've been talking about over the last few days, isn't it, Chrissy? And you spoke to Sharon Bell just recently, who was giving you thoughts on this. One of the big things that we're watching, buybacks, and the role that this plays in EPS, because, you know, that there's a reason that companies do this. You can talk about it negatively and say, well, it's just to flatten the bottom line, or you can say, well, the company doesn't think there's anything that's going to deliver more to the bottom line than doing this, and that's why they're doing it. But maybe we should tune into that conversation a little more.
Yeah, absolutely. I mean, again, it's a question of a little bit of the fundamentals getting distorted, or perhaps not even distorted. Take a listen to what Sharon Bell over at Goldman Sachs had to say.
I mean, the next couple of years, we think EPS can grow for these companies, but that's largely because you're getting a smaller and smaller number of shares over time. So your EPS can grow even if your sort of headline dollar amount of income doesn't grow. Just the fact that you've been buying back shares, you've got a smaller number of shares, you can see EPS grow. And I think for companies which are slower growth, older economy companies, that makes absolute sense.
Goldman Sachs' Sharon Bell today speaking to Marcus Today in yesterday's program and really talking about this idea that perhaps the buyback picture may be distorting markets a little bit, but it's also creating this kind of ripple effect in the earnings per share simply as a function of flow. Taking some of those shares off the market is going to make that EPS number a little bit higher. Let's get a little bit more context on this. And please say Hugh Gimber, global market strategist over at JP Morgan Asset Management, joins us this morning. Let's start with the buyback picture here. Do you agree that this is a positive for the EPS? Is it distorting the market? Your take?
I think it is a positive. You look back over the past 10 years, US markets have had all of the benefit of buybacks coming through at a time where European and UK CEOs have been much more reluctant to do so. Now, when you look at some of the dividend yields on offer in Europe, and then you add on another 1.5% to 2% on buyback yields, that's 6-7% of income that investors are starting with before they need to worry about share price volatility. So I think take these numbers as you see them. This is a sign of corporate confidence. And I think most interestingly, we have a great chart on this in our pack, which shows how historically, US buyback yields have tended to be 1.5, 2 percentage points higher. It's in the past 6 months or so where European CEOs are maybe saying, hang on a minute, our valuations look pretty discounted. Perhaps it's time to start buying back some shares.
But isn't that a function of liquidity, though, when we're talking about the American markets versus the UK ones or even the broader European ones as well? In the absence of that liquidity in London, for example, we were talking about TUI earlier, moving to Frankfurt for seeking some of that liquidity picture. Why are buybacks so much more important?
Well, first of all, I think in a year where you've had valuations doing all of the work, investors need to think about a broader source of return this year. And so, look, we'll take 1.5%, 2%. I think also it's telling you something about the cash on company balance sheets, right? You have options today. If M&A looks less attractive, but you still want to return some capital, go and give it back to shareholders. I really don't see a problem here.
Yeah, so that's the upside story on buybacks, Hugh. Good morning to you. What about the investment that we want businesses to make at this point? And one of those is around technology and around AI, perhaps. Where do you see opportunities on that front? Where are businesses deciding not to return cash to shareholders, to keep it, but to employ it?
Of course. So there's a balance to be struck, right? Obviously, you want this money to be going back into the economy. I think there are a couple of reasons that are maybe holding businesses back here. First of all, election years tend to lead to lower business confidence all in all. It's one of the few consistent macro indicators where you can say we can draw a significant conclusion from this being a heavy election year. Second of all, obviously, the cost of financing for some of these projects is that much more restrictive. And so I think it's quite natural that many corporates, particularly in places like energy and materials, are turning to some other ways to put money to work. Equally, you look at areas like healthcare, industrials. I think the industrial sector is particularly interesting given some of the government support that we see coming through, not just in the US, but also with Europe. Things like the recovery fund still taking a long time to get going. Only 35-40% of that fund has been spent so far, but we expect that to tick up. And so I think a potential upside this year is maybe if we start to see some more of that kind of fiscal support that, again, the US market has benefited from historically, but the potential for some convergence now.
Yeah, and certainly we focus in on the Inflation Reduction Act and the IRA, and that takes me, and you mentioned this, politics and the willingness to spend in a very heavy political year. To what extent is this starting to creep in or maybe even dominate investor conversations now, Hugh? The prospect of perhaps change in US politics, where that leaves some of the investment themes that under a Democratic presidency have been talked about a lot by investors, for example, investing alongside the government on green initiatives.
Absolutely. So it's certainly dominating conversations today, but I do not think it should be dominating decision making. A year is a very long time. A week is a long time in politics, as they say. And so we have a long way to go until November the 5th. Equally, you look back historically, over the past 3 presidential terms, roughly half of the policy commitments that have been laid out in advance of an election have ultimately made it into law. And so I think there's a very important sort of thinking process to be done here in terms of what this could mean ultimately for the fiscal picture in particular, obviously implications for the bond market. But today, I think the right thing to be doing is doing your homework and not taking investment decisions off what you perceive to be a likely outcome in November, because there's just too far to go in terms of what we know about what's going to happen.
We can certainly be a long time in politics. It can also be an eternity in markets as well. Talk to us about this bond market here. We're seeing a breakout above 420. 431 is how high yields went. There is a concern that if yields go any higher, it could shake the stock market. What is that threshold?
So, I mean, I've been surprised at how resilient the stock market has been to what has been very sharp moves in bond markets over the past few days. I think probably when you take all of the data that we've had in aggregate this week, it actually tells you not so much about the economy, it tells you a lot more about market positioning. It tells you how excited people have become around this notion of immaculate disinflation, where we just see inflation cruising back to target without needing to see any kind of weakness in growth. Net, okay, US CPI yesterday, a little hotter than expected, but still, ultimately, we think this is a cooling economy. It's just cooling that little less quickly. It's going to take some time to get back down to 2%, and I think you have to be very careful here not to get dragged into this sort of polarized debate as to whether this was all just a January effect and can be completely written off, or whether this is signaling the return of rate hikes and a real inflation problem. You pick through the numbers, I think it'll end up being a bit of both, where some of this pressure in shelter will reverse over the coming months, but equally, we see in areas where the labour market is still strong, some still resilient spending in other parts of services, which is just going to need to take that cooler economy and a bit more time to get the Fed more comfortable in thinking about cutting rates.
Well, at its core of the Fed, and I'm going to put you on the spot here, we've only got about 30 seconds, at the core of the Fed's conversation is what's happening with wage growth. You're seeing it on a corporate level as well, with massive layoffs in the United States, of course, but even wage growth here in the UK. How much of the wage growth story is eating into corporate margins?
Yeah, I mean, it's been a problem, I think, not so much over the past couple of years. I think it's more this year, right? Margins have done very well because consumer demand has been strong. The consumer weakens this year, some of that exuberance, particularly in the US, starts to fade. I think margins will have to come down because the ability for corporates to pass on those extra labour costs is just going to be that much more challenging.
It is interesting the way we've seen so many job losses announced, and yet so many people being reabsorbed then into the labour market. We were talking in the last hour about, in particular in the tech sector, and those very skilled people going from tech businesses into other parts of the economy, perhaps taking some of those AI skills with them. Have you been surprised about the resilience of the unemployment story over there?
Yes, we have. I mean, you'd expect on paper higher interest rates tend to slow an economy down, and we're just not seeing a huge amount of that in the labour market so far. I think there's an important element here where this idea of a rolling recession that's been trickling through different sectors at different times is one way to understand some of the data that we're seeing. You go back to this time last year, we were in a spate of tech layoffs. People were saying, you know, you had 300,000 jobs lost in the first couple of months of 2023, and then things moved on, and the AI story picked up at a time where some of the services sectors started to feel a bit more of a pinch. So ultimately, yes, the labour market has been resilient. We think it slows this year. We think that helps to bring wage growth back in line for the Fed.
Okay, Hugh, thanks so much. Thanks for joining us. Hugh Gimber, Global Market Strategist at JP Morgan Asset Management. Let's think about some of the stocks on the move this morning, and Joe Easton rejoins us with a briefing. Joe, we were doing our best to keep track of them at the top of the hour. You've got a recap for us.
Absolutely. So we're starting with the Dutch earnings, and Heineken down almost 5% at the moment. That's the biggest drop since July when they last issued disappointing guidance. But today it's about the volume. Beer volumes finally starting to weaken. Previously the concern has been around the spirit space, but now beer is catching up and we are seeing those volumes coming down. But in terms of the other Dutch companies, ABN AMRO jumping almost 6% at the moment, doing that €500 million buyback. Also, there is lower impairments than expected in terms of the property impairments. That's what analysts are pointing to in some of the notes today. And Hold jumping as well. The grocer, their profit not as bad as expected as food prices start to come down. That was a concern heading into that one, but we're seeing those concerns ease at the moment. Then in terms of some other earnings, we're over in Germany taking a look at Delivery Hero, up 4%. It's had a terrible run over the past month after concerns around a collapse of one of their sales over in Asia in terms of their business over there. But their sales today are positive at the moment, and they are coming up at the moment over in Germany. ThyssenKrupp in the steel space, weak results from them, cost pressures, cash flow, both a concern for that company. And then Verbund, this is over in Austria. It's a power firm, a massive company, €20 billion company, tends to go under the radar in terms of our coverage, but they're doing a special dividend today, and that one is helping that one to gain over in Vienna. Norsk Hydro, we're back in metals here with aluminium. Again, a weakness. Aluminium prices coming down, so that one's a weight on that stock over in Oslo. Then in terms of a quick look at a few UK stocks, that easing in inflation is positive for a number of sectors, including Lloyds in the banking space. We'll get banking earnings next week from the UK, and also NatWest on Friday, and also the home builders, Taylor Wimpey, gaining today. Utilities tend to benefit as well from easing inflation. And we've got earnings out of both Severn Trent and United Utilities today, so getting a double boost for those companies this morning. Then just one morning call to point out to you today. This one caught my eye. BAE Systems is downgraded today over at Jefferies after 2 years at buy. They say that given the rally of around 40% last year alone, that could potentially come down as geopolitical risks start to ease. That one comes down to hold over at Jefferies.
Really interesting dynamic, given that we're waiting for perhaps more defense spending to actually increase some of those stocks. Joe Easton from our equities team, we thank you so much for walking us through those early movers this morning. Coming up, we dive into some of the earnings stories. Joe was just talking about Heineken, as he said, dropping those price increases, hitting volumes in a very big way. But it's not alone. We're going to dive into some of the Dutch earnings next. Stick with us. This is Bloomberg.
London will stay a financial center. It will stay our EMEA hub. We'll just have a rebalancing onto the continent. And actually, the numbers of who has moved across aren't that big. So it's sort of in the 200 level. And if you think about 15,000 people, that's sort of not that material. And so I do think both will basically continue to grow and continue to be very relevant. What will change, though, and the big thing that's changing, is actually the risk-taking is what's going to move. And so we've historically had risk-taking in the UK. That risk-taking and the assets that go with it, not the people alone, but the assets that go with it, that's the next phase of what we're now moving into. And that will be a material change.
Studios in New York and San Francisco, our expert hosts have the data and analysis about the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action. 11 a.m. on the East Coast, 8 a.m. in the West, only on Bloomberg Television. Context changes everything.
This is Bloomberg News Now.
News when you want it at the touch of a button.
Another volatile day on Wall Street. We're seeing big moves.
All eyes on Capitol Hill as Democrats and Republicans prepare.
Today's job numbers casting doubt on the Fed's next move. Inflation remains front and center. And that's news when you want it with Bloomberg News Now. Get it 24/7 on the Bloomberg Business app, Bloomberg.com, and anywhere you get your podcasts.
Bloomberg News Now. Context changes everything.
Authorities
could face bigger challenges next.
It was going to keep reading World Cup. This is a three
as the economic picture
covering the intersections of Hollywood, Silicon Valley, and beyond.
very importantly, we see moderate but sequential improvement in our volumes as inflation is starting to come down, and consequently the need to take pricing. We had double-digit pricing in the first half last year, high single digits in the second half, and we see pricing further decelerating into the new year, and that for sure will help the volume momentum of the business.
That was Dolf van den Brink, the CEO of Heineken, speaking to us a little bit earlier on. Let's focus in on today's earnings stories coming to us from the Netherlands. Bloomberg's April Roach joins us with a rundown of some of the consumer-facing stories that we've covered. April, good morning. So we spoke to Dolf from Heineken a little bit earlier on. There we just heard him talking about how inflation's coming down, so there's less need for them to pass on those higher costs in the form of higher prices to their consumers. But a lot of the focus was going to be on their performance in the Asian markets. What did you take away from the statement this morning?
Good morning. Yes, so from today's report, we saw that overall Heineken sold less beer last year due to high inflation and those challenging market conditions that the company mentioned. And the shares are down more than 6% on that news. And the brewer's full-year organic revenue growth missed estimates, and also its full-year organic beer volumes also came in lower than expected. And the firm was really impacted by that brutal sort of summer weather we saw in Europe last year. And it's also, as you mentioned, been facing some challenges in certain markets. Analysts were really looking to see how it performed in its key Asian markets like Vietnam and Cambodia and also Nigeria. And we saw today that those conditions remain really tough in those markets, and that these areas continue to be a drag on its profitability. And Heineken also cited high energy costs and high input costs as also being part of some of these factors that are contributing and weighing on consumer sentiment.
It's a really interesting dynamic because they started talking about the Asian markets, the Nigerian markets, how that was for them the bigger pieces of their equation, as opposed to what you would traditionally think, you know, American beer drinkers or even European beer drinkers, which both make a third of their revenue. A fascinating story in the consumer space, but let's stick with that sector story because we also get numbers out of Ahold Delhaize. When they are talking about their recovery in the United States, its largest market, they're the parent company of so many grocery chains there. What did they say?
Yes, so for Ahold Delhaize, its key metric, which is its adjusted operating margin, actually beat estimates. And what we've seen for Ahold Delhaize, this retailer, is that it's faced multiple headwinds in the U.S., and that's due to the U.S. government unwinding its SNAP benefits program, higher interest rates, and also the restart of student loans. And all of those factors are sort of weighing on its margin in the U.S. However, the firm actually performed better than expected in the U.S., which, as you said, is its largest market. And this was also helped by a one-off adjustment caused by the divestment of its Fresh Direct. That also really helped to boost results. And also in Europe, the firm said it saw positive volume trends in certain markets and certain brands. The first time it's seen those in over 2 years. And that has also really helped to drive growth as it sees a sort of turning point coming up in Europe. So all of these factors combined helped Ahold Delhaize perform better than expected.
April, thinking about the consumer and what these earnings reports tell us about the consumer, clearly they both have their own geographies and they represent different geographies and the highs and lows in each. But tell us about what you're taking away on the consumer demand story from businesses like Heineken and Ahold.
Yeah, so if we start with Heineken, it provided a really cautious outlook, and that is on the back of that sort of slowdown in consumer demand. And last year, Heineken already tempered its outlook for 2023 multiple times due to those tough market conditions. And the firm said today that it expects slowdown in consumer demand to continue to weigh on its beer volume. So those drags will continue into the next year. When we look at Ahold Delhaize, the firm said it expects its performance this year to remain quite consistent with last year. So it gave a forecast for 2024 that kind of replicates what it was looking for in 2023. But Ahold Delhaize sees this as a kind of achievement that is able to maintain its margin expectations amid this challenging environment. So really there we can see both companies being quite cautious on their outlook for 2024.
April, thanks very much. April Roach joining us there on the earnings stories out of the Netherlands this morning. There have been a few of them, those just a couple of the consumer-facing ones. Let's talk about the macro picture here in the UK. We got inflation numbers at the top of the last hour that came in a little lower than had been expected, 4%, the number matching the prior reading, the prior month. So this is the January number, matching December, a little below the 4.1% that we had maybe been anticipating. Let's get the details then. Bloomberg's UK correspondent Lizzie Burden joins us now with more. Lizzie, good morning to you. The pound didn't like this. Stocks do like this, and that's clear when we look at what's going on in markets this morning. Where does this leave us then? We've got CPI coming in, yes, a shade below estimates, but still double the target.
Well, I think the reason that markets are shocked by this is that you had that nasty shock out of the US CPI print yesterday. So traders were really braced for inflation to go up again. That's what economists thought would happen, and it hasn't. You also had the labour market data yesterday, and traders had paired their bets on when the Bank of England would rate cut this year. Actually, now they've flipped back, so they're fully pricing in 3 rate cuts from the Bank of England again. I've been getting trolled by Torsten Bell from the Resolution Foundation off the back of this. I feel like I'm getting... he's really targeting the markets, but the point is that it's an overreaction in his view to really just blips in the data. We're talking about a 0.1% margin here.
What is actually, in terms of the nitty-gritty, what is actually driving this drop? What part of the data?
Well, so you've got core inflation lower than economists thought. Services inflation actually is a key consideration for the Bank of England, and that edged up, but by less than expected. And even if you look on a monthly basis, the drop was double what economists expected. So a lot of relief for not only the Bank of England, but also for the government as well. Now we just need to see whether Britain tipped into a recession tomorrow. And that was thought to be, a difficult backdrop for the 2 by-elections that we've got in the UK today, but I'm sure that this print will be a relief to the Prime Minister.
Yeah, really interesting, and we'll see what the growth picture delivers, what the recession picture delivers, even if it means more to the politicians perhaps than it might to the market on that sort of very binary thing. What about where this leaves the Bank of England then, Lizzie, on the back of this data and yesterday's data? Where are we heading?
Yeah, it's obviously looking like we're still going to get rate cuts this year. The question is the timing. The pricing now is that traders are fully pricing in the first move in August. They do see 3 cuts this year. Do we get more in 2025? 2025, I have to think what year we're in. 2025 next year. That is more questionable. But as you've seen, the pound's down to 125, a 1-week low. Gilts have had a big rally off the back of this as well.
All right, Bloomberg's Lizzie Burden, thank you so much for walking us through that story. And as Anna had said earlier, there is a little bit of green on the screen when you look at this equity market, but it's still the earnings picture for me that's kind of standing out when you look at even what the Stock 600 is doing this morning. Some of your heavyweights, your luxury names, your consumer names, they're all dragging this index lower.
Yeah, exactly. So that's where we're focused in terms of that earnings story. I was looking at bond markets, and of course we're really still in reaction territory to the US CPI print, aren't we? Yesterday we saw yields going higher across various geographies, and today we pull back a little bit from that. So European bond markets, we see yields a little lower, US Treasury yields a little lower, and the UK story exaggerating that move. So if we maybe overdid it to the upside yesterday in terms of yields, well, they're coming down quite substantially, down by 9 basis points on the UK 10-year today. So certainly we're seeing some, all of the moves today need to be considered in the context of yesterday, don't they?
Yeah, they really do. And again, it speaks to this idea of how much is the investor base really looking at this data report, even from right here in the UK, as some sort of one-off, as some sort of January blip, if you will. That's going to be something that remains to be seen as the European trading day continues. But coming up on the program, we're going to be speaking to the CEO of Capgemini, talking about whether or not this previous story is AI, if we're starting to see kind of this more leaning in to that story and what that actually looks like in terms of numbers when we're talking about whether or not, again, this investment is actually going to pay off in the next year or so. Stick with us. That interview next. This is Bloomberg.
How are you feeling right now about the state of the industry and what it's going to look like in the next couple of years?
The big picture is it has never been more, I would say, volatile. I mean, it has, but it continues to be volatile. But like you said, we did see real signs of life this summer. So generally speaking, box office is down globally around 20% to 2019, so pre-pandemic levels. But this summer, it was 5% down. Right, so it would suggest that even though there were winners and losers of this summer, and obviously we had the two big juggernauts with Barbie and Oppenheimer, movie-going begets movie-going, right? So when there's a season filled with, good movies that people want to see, I was made to feel pretty optimistic about what we saw in the summer.
UK, your source for news and analysis covering the biggest challenges facing the UK government, economy, financial services, and markets.
Tax cuts should not be the priority. It's about a credible plan for growth over the next 2-3 years.
In this post-Brexit world, how do you see actually servicing your clients?
It was disruptive, and it's going to have implications to how capital raising works.
Now we're having the perfect storm in the UK.
Watch Francine Lacqua Thursdays at 9:30 a.m. only on Bloomberg. Context changes everything.
What happened was you were offered a money-losing women's basketball team, and you said, I want to be in the other sports as well. Is that right?
Well, yeah, you got to be smart about this.
This is Markets Today. We're about 30 minutes into the European trading day. It's all about balancing the macro and the micro. We have a little bit of the CPI data on both sides of the Atlantic to really talk about stronger numbers in the U.S. unexpectedly, but slightly weaker numbers here in the U.K., creating a little bit of a positive reaction in the U.K. equity market here, but seeing some weakness in the pound as well. Has the U.K. market really digested some of that U.S. data? Does it even matter when they have some data of their own? But then talk about the micro as well. When we're talking about some of these earnings stories, a flood of them coming out this morning, a mix of disappointing buyback news out of ABN AMRO, some weakness over in the U.S., weighing down the Heineken numbers. And then you have Capgemini, Anna, which is actually higher by 4%.
Yeah, absolutely. The stock trading higher this morning, up by 3.8%, as you say, rising after the results, setting its targets for 2024. So we'll dive into this conversation right now then. We're joined by the CEO, Ayman Ezzat, who is with us from Capgemini. Ayman, thank you very much for coming to talk to us. The market responding quite positively to what you've reported this morning. The share price trading higher. Looking at the new guidance you've given for 2024, does that make sense to you? Were you hoping to guide the market a little higher this morning?
No, I mean, basically we're guiding the market based on the perspective we see. I think what we're seeing is today we have seen a year of deceleration in 2023. We performed quite well. We end up basically within the guidance we gave around the growth at the beginning of the year. The operating margin was better. The cash was better. We're seeing now the trough in Q1, and we expect from there to start to see a recovery overall from a growth perspective as we go through the year, with a pretty good exit rate in 2024, basically setting up for a return to pretty solid growth in 2025. And I think probably that's what the market is appreciating, is the fact that we expect to see the trough in Q1 and from there to see the recovery through the year.
What gives you the confidence in that trough in the first quarter, as you describe it, Ayman? I mean, is this to do with your expectations around companies spending on IT and spending on consultancy? Do you see them more and more willing to do that after the first quarter?
So first, we see our pipeline. We ended up as well with a pretty solid, bookings in Q4. We see the budgets that clients have planned for 2024, the discussion we have with them. And then we see the number of projects that will start or are starting, in the next couple of quarters. That's what gives us the confidence, is we expect the investment cycle to come back. Number of, some industry like financial services have cut to the bone around some of the tech costs, and we see them to, starting probably in Q2, Q3, to start to unlock more budget because they have to make some of this investment to continue their digital transformation. So we continue to see positive traction, and we see new areas, for example, around sustainability. We have developed quite a bit of offerings, and we launched around climate tech last year. And now, for example, we're involved in a number of gigafactory scale-up across the world, not just in Europe. And of course, this is new business that's coming in that will scale over time. You haven't yet opened the subject on Gen AI, but the Gen AI discussion are opening a lot of discussion around transformation across the firm, which again, setting up for a number of new potential projects that we see coming through the year. So there is a lot of discussion which are positive, trending towards more spend, in the course of the year with positive value impact at our clients.
Eamon, you read my mind there. Let's talk a little bit more about that AI picture. Capgemini recently announcing that multi-year collaboration with AWS on artificial intelligence. But walk us through the thinking there. Why pick AWS when, if you actually look at some of the market commentary, there is concern that AWS isn't spending as much on AI relative to, say, Alphabet or Microsoft? Why AWS?
So first, we work with all of them. We have set up partnership on Gen AI with Microsoft, with Google Cloud, with AWS, with Salesforce, and more recently with Mistral AI, and more to come. So we work with all the players. AWS has also very good technologies. They have very strong presence at clients. And we are working on developing a number of industry use cases with them on Gen AI that will bring value to our clients. So we work with all the players across the industry, and we have pretty deep relationship with all the hyperscalers. And we have working with a number of them on development of these use cases, which ultimately that's really what creates value, at clients. And because we are lined up with a number of them around specific industries, that's what basically put the focus in terms of development of use cases. More recently, the partnership we have with Mistral AI in France, which is a French firm developing foundation models and LLMs. These guys are extremely good. They have a very efficient model. They are more open, and a number of clients are very interested in terms of implementing their technology. So we'll continue to explore, the technologies and the players that will bring value to our clients, will help accelerate the development and the implementation of the Gen AI use cases.
Eamon, what is the payoff here? When does all this AI investment, with whichever partners you choose, actually pay off? There's a question of whether this is a 12-month story or a 10-year story. When do we start to see the investment pay off?
So there have been some quick payoffs in some areas. The most worked out example is the famous call center example, productivity, and people have seen, improvement quite quickly. In some others, it's going to take more time, because it's not just about developing a nice algorithm that basically enables you to make decisions faster. It's how you take that at scale in your company. What you need to change is target operating model, in KPI, reskilling people, changing processes. So some of it is hard work, but this is also what's going to bring the much bigger payback. We will see, acceleration in R&D development cycle, how to innovate and to be able, to design and produce cars much faster. Same thing around R&D in pharma. There's a lot of innovation around, how do you increase the hit rate around molecules, and how from there to be able to bring, products to market much faster from a drug perspective, and to be able to address, smaller diseases where initially people would not put the money on the table to be able to go after them. So there's many, many areas across the value chain of firms. But besides some of the obvious ones and the quick ones around how do you search through technical manual faster, how do you improve your productivity of call centers, a number of the others require more deep change, which will bring also much bigger payback over time. But the value of the technology is definitely there, and its implementation will bring value, some of it in the short term, but a number of it will take a bit more time, but will be much bigger payback as well.
Eamon, do you see, are there arguments when it comes to the implementation of AI and the use of AI? Are you seeing conversations around smaller businesses being able to keep up with larger businesses enabled by AI? And I wonder what that does to your client base. I mean, maybe not in autos or that kind of sector, but in some of the sectors that you service.
I would think that on the innovation side, I think some small firms, some startups could leverage Gen AI faster than some of the larger firms where the change could take more time, where people could be a bit more conservative around the use. And this could accelerate some of the innovation and development cycle. I think on large scale things, I don't see like on large scale processes, on supply chain, on manufacturing, I don't think Gen AI will give an edge to smaller firms to be able to do things much faster. But definitely on innovation, on reactivity to customer demand, I think it definitely can help a small firm catch up a little bit on large firm based on the speed of implementation of the technology.
You operate, of course, in the technology space, Eamon, also in consulting, in supply chain management, engineering, across a whole load of different areas of corporate activity. We've seen a lot of consulting businesses talking about job losses in the United States, in Europe, in various geographies. What does the picture look like for you in terms of the headcount story?
So listen, we have optimized our headcount in 2023. But, that was planned. Our headcount is also linked to how much we need to hire in advance, linked to attrition and growth. So when things slow down, both from an attrition perspective and a growth perspective, we are able to better optimize our overall headcount, which is what we have done in 2023. Of course, over time, as we accelerate through the year, we expect headcount, growth to resume. We have been like in areas like consulting, like strategy and transformation last year, where some people have seen some decline. We continue to grow. We grew about 9% in strategy and transformation consulting last year, in spite of the slowdown in the market, because of the positioning we have taken around a business and technology partner and really enabling, large-scale transformation at our clients. So I think there is still life in the market. But of course, headcount will have to resume as growth resumes through the year. So I'm quite positive around, basically the growth perspective in terms of headcount in the coming quarters.
Eamon, a final question to you just on the macroeconomic environment here. Just given your business and so many of them that you're partnering with depends on the business investment story out of the United States. Recession bets seem to get pushed out further and further, and therefore business investment seems to continue to be fairly resilient, fairly strong. Is there any sort of prediction on your end of when that might ease?
Well, again, intentions are there. When you look at the pipeline of project and demand that we have from client, decision cycle are still a little bit long, so they're not at all like we had in 21 and 22. We expect, like a number of other people, some acceleration through the year. And of course, even if interest rates, have decline has been pushed a little bit further into the year, it will end up by coming down because inflation will end up by coming under better control. And I think this will accelerate some of the decision around the development cycles, the investment cycle that we have seen as being a bit delayed right now. But the intentions are there, the discussions are there, so it's not like we're going to go and have to find new things to do. It's all there. It's just a question of speeding up some of decision making.
Eamon, thank you very much. Thanks for joining us today. Eamon Ezzat, the CEO of Capgemini. Kriti, really interesting positivity, I suppose, coming out of the messaging there, the stock on the rise as a result of some of the guidance we're getting through from Capgemini. But just in terms of what it tells us about the broader story, in contrast to other consulting businesses that have been reducing headcount, this is a company talking about growing this year. They have cut back previously. But also just in terms of the business as a whole, a trough in the first quarter is how he described it. And then acceleration through 2024, including for financial services, where he says, they can't freeze IT spending forever.
I mean, that is a contrarian take, by the way, because as he's talking about this acceleration, so many people are talking about kind of cutting the purse strings a little bit. It's why you're seeing so many layoffs on Wall Street, on Silicon Valley as well, because they're talking about that easing in terms of cost efficiency, the fact that they actually need to make the numbers work for them. So his optimism is quite interesting in that regard, but so is it around the AI push as well, where Capgemini is partnering with likes of AWS, and then he also said Microsoft and Alphabet as well. His time frame is saying there is a short-term payoff, but most of this may take a little bit of time still.
Yeah, absolutely. So we'll continue to focus on that timescale when it comes to the AI dividends. Coming up on the programme, we'll get back to macro themes here in the UK. UK prices rose less than forecast in January. But is it enough to move the dial on interest rates? We will discuss that next. This is Bloomberg.
baby boomer generation, and this generation is now increasingly dealing with problems relating to Alzheimer's, dementia, and so forth. Not particularly my age, but maybe some people my age, even younger, but obviously in their late 70s, 80s, and 90s, more and more we're reading about Alzheimer's. Is this an epidemic that you can't really do anything about, or is it something we can deal with in some way?
It's a real challenge for a lot of families, mine included. You know, I have a 90-year-old grandmother at home who's struggling with dementia, and providing care for her has been a real challenge. And for my family, we love her dearly, we want to be there for her, but it's painful for us to see the toll dementia has taken on her. This is rightfully, a concern for families across the country. We're investing a lot in studying dementia, to not just Alzheimer's, but other forms of dementia, to understand what's driving it. But very interestingly, there's also some research that's taking place, lifestyle research, if you will, on the impact of diet, of social connection, of physical activity, and sleep on dementia as well. Dean Ornish, professor at the University of California, San Francisco, has been actually one of the key folks, who has been leading some of that research on the impact of lifestyle and dementia. This is a promising area.
Always on the heartbeat of the tech
spread across global markets.
The real-time data aspect is going to be important.
We're going to bring you expert analysis on that. Sure.
Don't miss Bloomberg's interview with the
Welcome back. This is Markets Today. We are 45 minutes into our European trading day, and we have European stocks broadly positive. A lot of that positivity, though, coming from London, and we'll dive into the reasons for that immediately. We're up by 0.4% on the FTSE 100, and in fact, the gains go broader than just the FTSE 100 across the board. When it comes to the FTSE 250, the oil share, we're also seeing positivity there. That stands in contrast to a little bit of sluggishness elsewhere on markets, pretty flat in Paris and Berlin, but really it's the standout FTSE story or UK story, but that's been driven very much by the macro and what we got out of the inflation print this morning. Let's return to that theme and bring in Anna Andrade from Bloomberg Economics, and bring in Bloomberg Markets Today reporter Sophia Horta-Acosta, who's with us on set. Anna, let me come to you first. So we've got the CPI print then at the top, well, an hour and 45 minutes ago, so we've had some time to digest it. It came in weaker than had been expected, but it's still double the target that the Bank of England, of course, has set for it. It's a little lower than the 4.1% that was expected, coming in at 4%. What's the standout? What do we need to know about the drivers behind inflation that really matter this morning?
Hi, good morning. So yeah, exactly. I think you explained it exactly right. So it does at first sight seem like a very sticky reading because inflation just stayed unchanged at 4%. But compared to expectations, it did come as a relief because we were forecasting 4.1, and the BOE was forecasting 4.1 as well, and it came in at 4%. Now, the downside surprise came from services, which is sort of the good news of it. And it came from services came in at 6.5%. The BOE had expected 6.6%. So that's another downside surprise. What drove it a bit was the airfares. So airfares, we had expected it to mechanically push up on inflation because we were expecting some base effects, but because it had a bigger weight, that actually acted as a drag. Now, what does that mean? It's good news for now. It might mean that we'll have a bumpier road ahead because airfares and accommodation are volatile components and they have bigger weights now. So, that might be that the path of inflation ahead will be bumpier. We think that the BOE will overlook that volatility. And the important thing is that today's data still leaves inflation on track to undershoot the 2% target by spring.
Okay, so that's the big picture. Let's come to you, Sophia, on what this is doing to other assets, if you like. I mean, we saw the pound drop as a result of this, and then the FTSE 100 and other markets go higher. Sometimes when we reassess rate expectations, it has a different impact on the large caps versus the small caps. Today we see all, the rising tide lifting all of those boats.
Yeah, and I think context is everything here. I mean,
if you really consider how much of a surprise today's print was, it was 10 basis points on the headline number. That's not much, but it's really after the US CPI data kind of made everyone panic about the interest rate cut outlook for the world globally this year. And today, you know, markets were really set up for another disappointment, and they did not get that. I think that's the key here. It's not the scale of the surprise. You would expect there to be a much, much bigger, you know, even perhaps a slowdown in inflation. If you looked at where gilts are, we're seeing double-digit drops in the 2-year, in the 5-year. That's a reversal of yesterday's move. The FTSE leading Europe. I think that's very rare for me to see on my screen, and volumes are quite high. So there is conviction behind this move. A recalibration of where rate cuts will be also for the BOE, a little bit more conviction on that August cut, and maybe pricing in one more for this year. But it really shows you just how sensitive markets are to really, really small moves in the inflation print from 4.1 to 4.0. Again, just 10 basis points.
In terms of what shakes this market, though, in terms of pricing for the BOE, what is that? This is a positive number you're seeing in the equity market. What is the spook factor? What freaks investors out here?
I mean, I think anything that is where expectations are is really the context is where we need to take this, because it's the hard numbers. And I was talking to Dave Goodman on my team on the desk earlier. You know, why are markets so obsessed with inflation when wages yesterday didn't really move the needle in the UK that much? And it's because it's really kind of data that's based on hard facts. You know, Anna was talking about airfares. We're also looking at food. I mean, that was a big downward contributor to prices as well. But you know, this is really again, it's because of what happened yesterday in the US that markets are taking this so positively. I'd be interested to see whether this lasts the day, honestly.
All right, well, Anna Andrade, come back in here for us. When we're talking about this kind of divergence in some of these reports, you're seeing a really strong inflation report. Really strong is saying highly, but one that certainly missed the expectations on Wall Street versus one that's coming in softer in the UK. Is this the start of a bigger divergence between the Fed and the BOE?
Yeah, no, that's a very good question, and I think we still don't have a clear answer. I think both. Yeah, I mean, today's print was a very positive one. Let's call it, but there's still sort of a bigger question of whether, you know, the disinflation or the fast disinflation process that we've seen towards the later last year has more room to go or not. So in the US, I mean, it could be that we get a positive surprise in today's UK inflation, but then we get, you know, a few of upside surprises in coming months that kind of completely change the narrative. So I think it's still an open question. What I would say is that the difference between the UK and the US is that in the UK, the economy is pretty much stagnating. I mean, we have GDP numbers coming out tomorrow. We are forecasting actually the GDP data to show that the UK was in the midst of a technical recession in the second half of last year, and the labor market is cooling significantly. I mean, there's sort of some questions around the reliability of the official data, but the big picture is one of cooling. And in the US, the economy is still going pretty strong. So, and then the other big difference between the two is that in the UK, we are going to have a big disinflation in force, that it's the fall in energy prices. So in April, we're going to get the off-term price cap. That's going to show a 15% decrease on utility bills, and that's going to help a lot in getting us to 2%. So those are the two differences between the two economies.
Okay, so Anna, it's a combination of that base effect on energy, perhaps, and the weakness in the stagnating economy that you described that takes us back down to below target in the spring, which I think is the Bloomberg Economics forecast. What do we need to know about and think about when it comes to the fiscal impulse here and what the government might be tempted to do with tax cuts? How is that complicating the outlook for the Bank of England this year?
Yeah, so one of the reasons why we actually think May, and we've been saying for a long time that May would be the earliest possible window and the earliest possible meeting for the BOE to start cutting rates, is exactly because of that, because we're going to have the spring budget on the 6th of March, and the BOE will want to see what comes out of it. Now, in the autumn statement, we saw a big giveaway in tax cuts, but they weren't inflationary. The OBR didn't judge them inflationary. The BOE also didn't judge them to inflationary, essentially because they were targeting income tax, and they also helped to bring people back to work, so to increase the labor supply. So supply was increasing, and there was not so much inflationary aspect. The key question now ahead of this budget is one. I mean, the first one is, will Jeremy Hunt will have enough headroom to kind of significantly loosen policy, and the second is which tax cuts will he focus on? We think that his main priority is to kind of focus on tax cuts, again, on income tax cuts that are not inflationary, because he doesn't want to derail the easing cycle of the Bank of England. But we'll have to see and wait and see.
Anna, thanks so much. Thanks for joining us. Anna Andrade from Bloomberg Economics. Thanks to Sophia as well, Sophia Horta-Acosta from our Markets Today blog. You can get more from Sophia's team on the blog. You go to the Bloomberg UK website, or you can type TLIV Go on the Bloomberg terminal. Both of those will take you to that blog page, which, of course, covers a lot to do with UK markets, so has been busy with that inflation print this morning. Here on Bloomberg TV, we're going to be focused on a number of data points as we go through the day, so let's bring those to you. 10 a.m. we'll get Euro area GDP and industrial production data. So that's in just over an hour's time, some data to watch out for on the Eurozone front. Then we'll get at noon US mortgage application numbers, a big focus on the mortgage market, of course, over in the US. 3 p.m. today, Bank of England Governor Andrew Bailey will be testifying to the House of Lords. Interesting to see what he has to say, what context he adds around that inflation print that we got this morning. Really interesting on services and where it diverged from expectations there, because services and wages have been a real area of focus for the Bank of England. And then at 5 p.m. we'll hear from the ECB's Governing Council member Joachim Nagel. That seems like quite a lot. Not much US data. I mean, there's the US mortgage approvals in there. We get retail sales later this week, though, Chrissy, and that could be a focus when it comes to the US data story.
Yeah, it feels like we've got the big data out of the way for the last 24 hours. I think it's the next 24 hours, next 48 hours, I would argue, that really matter more, because over here in the UK, you have those GDP numbers coming out. So what Lizzie was just talking about, and Andrade as well, we're talking about whether or not you're actually seeing the inflationary pullback, whether or not this inflation report is, at the end of the day, a blip or not. But a similar story back in the States as well, because then you have those PPI numbers that are coming in on Friday. And the reason this matters so much is because in terms of the math, the PPI data factors more into the PCE deflator than the CPI does. So there's a lot of room here for the rest of the week for these inflation reports to kind of be either thrown out the window or really harped on in terms of Fed pricing.
Yeah, absolutely. So maybe it is one data point, but we'll see, some data points linger longer in the psyche than others, don't they? We'll see whether this is one that does linger. Interesting to hear, we'll be hearing from the ECB a little bit later on. We'll get those data points out in the Eurozone a little bit later. And we have heard from the ECB's de Guindos just in the last half hour or so, talking about needing more information to be sure on inflation. That sounds like the messaging we're getting from central banks around the world, really.
It really is, and that's going to all have a massive market reaction. Of course, we're talking about the bond market. The FX market matters as well. Of course, we've seen a big hit, for example, dollar-yen overnight, just coming off the inflation report. Some volatility in cable as well. All going to be digested the next couple of hours. Coming up later, we hosted a couple of big names on Bloomberg Television, including Canada's Natural Resources Minister, the President CEO of Barrick Gold, Lyft CEO, and the U.S. SEC Chair. All really exciting. Be sure to tune in. Stick with us. This is Bloomberg.
This will probably go down in history as one of, if not the largest financial crimes ever.
I cannot imagine a scenario where $8 billion just disappears.
Bankman-Fried has pled not guilty to multiple fraud charges.
Sam was just too important in the crypto community.
When someone says, I'm going to give $1 billion in the next 2 years, like that catches everybody's attention.
As time went on, their ideas got weirder and weirder.
I don't think he even had almost a conception at some point that it was wrong or right. I think he just had the mentality that he has to win.
This committee will not stop until we uncover the full truth behind the collapse of FTX.
Sue, Mark.
Are you in? I'm in.
I'm in.
We're in.
Will this be the last of its kind? No. This is the nature of capitalism. Get over it.
Nobody brings you top names like Bloomberg.
The point is that the economy is doing very well in the Netherlands, but the election was very much focusing on migration.
They had made 26 attacks. We'd given warning after warning, but we hadn't taken action.
Parliament has to stick to this. It has to comply with the debt brake. The debt brake is really a good ally.
I think we have made addressing inequality a key sort of driver of our policies.
Bloomberg. Context changes everything. Bloomberg covers the world with unmatched reach and resources. From more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg. Context changes everything. Newsmakers and market movers. This is The Pulse with Francine Lacqua.
Well, good morning, everyone, and welcome to The Pulse. I'm Francine Lacqua here in London with the conversations that matter, and here's what's coming up on today's program. Wall Street caught off guard as hotter than expected U.S. inflation deals a blow to the Fed rate cut hopes. Some relief for the Bank of England as UK prices rise less than forecast in January, with downward trends in food and household goods bolstering bets that inflation could soon return to target. Plus, Heineken slumps after the world's second biggest brewer warns persistent inflation and economic worries will weigh on beer demand. So let's take a look at the European markets map. Of course, a lot of the focus on what we heard from the U.S., the American CPI print, coming in as a disappointment for investors after a recent downdraft and price pressures that really helped build that expectations of Fed cuts. This is a picture for Europe for the moment. So you can see the FTSE gaining some 0.3%, the CAC 40 0.1% higher. We did have better than expected news out of the UK. Again, if you look at the pricing, for example, for easing in the UK, they've brought that forward by, of course, the Bank of England. Inflation in Britain came lower than forecast in January. Then we look at a couple of the earnings stories. I know we have Heineken. We have also others in Europe. So it'll be really interesting to see how that plays out across the board. Now, to talk about inflation, talk about Fed cuts and monetary policy, we're joined by Noor Al-Ali from Bloomberg's MLive team. Also joining us is Maria Vaitmane, Senior Multi-Asset Strategist at State Street Global. So thank you both for joining us. Noor, this is as expected, but not as expected, because the market got ahead of themselves, but central banks kept on saying, like, look, let's wait and see for data points.
Yeah, and central banks have been saying that for quite some time, and it's just a matter of the markets playing catch-up. But Francine, I think if we want to take a step back here and just realize for a second what the inflation data that's been coming out of the U.S., out of the UK, and the wages is really telling us that life is not really linear, right? We're looking at these data points, but in reality, we're looking at an economy that's really trying to get a grasp of itself. We also know that the last mile of inflation is notoriously quite hard to get a hold of. So, you know, if you're looking at today's data, you saw that housing and household services were the largest contributors to that inflation print, but that's largely driven because of higher gas and energy costs. You know, so that's the inflation resurging that we were talking about in the fourth quarter starting to materialize now. So if I'm talking about what's happening now, you know, ECB's Guindos just came on the tape and said, look, you know, yes, we are data dependent, but maybe it's also time for us to start looking at these projections and seeing where that inflation is headed. And in the UK, it looks like it's going all in the right direction.
Let's stick to the US for now. So, Maria, when you look at US expectations, and it's, you know, there's a debate on whether that last mile to get inflation down is tough or not. Like, where are we on that? And how much has inflation coming down been thanks to monetary policy action?
I think for us the distinction is very much between goods inflation and service inflation. And we know goods inflation, I mean, when Fed was talking about transitory inflation, that's really talking about goods. And we saw a huge spike a couple of years ago, it came down, now goods inflation is gone. Where we see inflation is services area, right? And services are strong, they're driven by labor market, and labor market is, I mean, it's slowing, but it's still very robust. So to us, I mean, yesterday's report was really vindication of what we've been talking for a while, is that service inflation is still a problem. So if Fed is really serious about bringing that down, then we need to see tighter financial conditions for a bit longer, and potentially higher chances of recession. So unfortunately, there is, to us, it's very difficult to see this kind of soft landing story.
But so, Maria, if you look at what we heard from U.S. inflation, what we saw for U.S. inflation data yesterday, coupled with actually that strong jobs number in the U.S., how quickly, we also had Jeffrey Gundlach saying, you know, we wouldn't see any cuts from the Fed before June at the earliest, if at all. Like, do you agree with that?
Yeah, I think we will lean that way as well. And again, that all comes back to the strong labor market. And it's really hard to see how Fed can justify being cutting rates very aggressively if labor market is that strong. So yeah, no, for us, we would lean towards higher for longer.
What surprised you the most, Nora, about the U.S. economy in general?
You know, I think it's that Goldilocks narrative that we keep touting and getting retested. Yesterday's inflation data showed us, as we've just heard, that there is still a lot for the Fed to do. And we've had, Fed's goals view that's going to come out later today, who's probably going to highlight that, And the Fed has constantly pushed back on the very aggressive market pricing that we've seen. And, ultimately, it really doesn't matter where the market, looks at the rate expectations day in and day out. Ultimately, it's a much longer horizon. We are expecting the Fed, the BOE, and pretty much all major developed central banks to start cutting rates sometime soon, sometime this year. We are pushing that timeline. But still, inflation is still a problem. And we don't want to see a repeat of that, 1970s episode where we still had that inflation continue for decades while, it was still much higher. So, if it means that the Fed has to keep, tighter reins on monetary policy, then so be it, until a time where we see that inflation problem dissipate.
Maria, I want to ask you about U.S. earnings in a second, but are a lot of stock markets actually priced to perfection, given what we've heard in terms of the inflation trajectory?
I'll probably have to still kind of bring earnings in. And for me, there's a key, stock market is really very, bipolar element. We have Magnificent Seven, we have everything else. In terms of performance of the stock market, but equally we have exactly that in terms of earnings. My favorite stat from earnings season is Q4 earnings growth in Magnificent Seven stocks. That kind of blended estimate is plus 50% year-on-year growth, for the rest of the market minus 10. So that's really the divergence, and that's kind of what's happened, divergence in earnings, and that's exactly what we see in terms of that divergence in performance of those stocks. So yeah, I'm not sure the whole market is priced for perfection, but I think there is a lot of justification in kind of market internals given the earnings backdrop.
Let's also talk about UK inflation. Of course, that came in below forecasts in January with downward trends in the cost of food and household goods. Consumer prices rose 4% compared to a year earlier, the same pace as in December. Now, the UK Chancellor Jeremy Hunt says the government's plan to bring inflation down is working.
Inflation never falls in a straight line. And although it's welcome that it hasn't gone up today, it is still double the target level of 2%. And we're not going to be able to relieve pressure on families until we hit that target and the Bank of England feels able to reduce interest rates. So this is a time to stick to a plan that is clearly working, but we need to make sure that we really get to that end point of inflation at 2%.
Now, for more on this, we're joined by Anna Andrade from Bloomberg Economics. So, Anna, give us a little bit of a breakdown of the data that came out this morning. Does it really make the Bank of England's job a little bit easier?
Hi, good morning. Yes, we think it does. Sorry, just had some problem with the audio. We think it does.
We can hear you, Anna.
Yeah. You can hear me? Okay, fine, sorry. We think it does improve the job of the Bank of England. Essentially, I mean, it's still sticky. The headline number is still sticky, but we got some positive news on services. Services was 6.4, it tick up to 6.5, but the BOE was actually expecting it to tick up to 6.6%. So that downside surprise is good news. And I mean, the important thing and the message that we got from the Bank of England in the February meeting was that it was open to the idea of significant policy easing as long as inflation played ball, as long as it came in line, broadly in line with its forecasts. That's what we had today. It's still on track to undershoot the 2% target by the spring. So it still looks like we'll have significantly easing this in policy this year.
So what does that mean for what the Bank of England does next? I know there was a very cautious Governor, Andrew Bailey, in saying, like, look, let's wait and see. They're not in any hurry. And at the same time, March 6th is also the budget. So that could bring extra inflationary pressures to the UK.
Yeah, that's right. And that's why we've been saying for a long time that May is the earliest possible window that the BOE will have to cut rates, because it will have the spring budget on the 6th of March, and it wants to see the outcome of that. So we had Jeremy Hunt, the UK Chancellor, doing a lot of tax cuts in the autumn statement, but they weren't inflationary because they focused a lot on income tax, and that also has an effect that it brings more people back to work. It increases supplies. In a way, it's not a threat to inflation. And the big question now is whether he will continue to focus on this sort of tax cuts, so focusing on the NICs that has positive effects on labor supply, or if it will do something else. We think that his main priority is actually not to derail the easing cycle of the BOE. So I think that's what he'll be focused at. So we're not actually expecting a lot of significant policy stimulus coming out from the spring budget, nor a lot of added inflationary pressure.
Anna, thanks so much. Anna Andrade there from Bloomberg Economics. So let's get back to Maria and, of course, to Nora. Maria, when you look at some of the opportunities in the UK, we also have an election in the next 12 months. I don't know whether it seems like a good place to be for investments.
I mean, yes, in a sense, yes. I mean, what we like about UK in general is that it's very defensive market relative to kind of overall benchmarks. So our kind of overall general outlook on the market is somewhat cautious. So UK kind of ticks quite a lot of boxes. Like in UK, we particularly like healthcare stocks. So there are quite a few very large healthcare stocks that have decent kind of earnings pipeline, a strong cash flow. So those type of things that we particularly like. It also has a benefit of not having many cyclical stocks, something that is kind of dogging European market, where we would be more underweight. So yeah, prefer UK to Europe. I think that's a reasonable way to think about it.
And Nora, what does that mean for gilts?
Well, look, I mean, they've really rallied in the recent months, right? And we've seen them also rallying now. And, they've taken back some of those gains. Gilts, the yields curve is still inverted. So there's still an expectation in the bonds market that we are somewhat in a recession. We are headed towards one at least. We've got the GDP data that's still due. It's going to give us some, inclination on where the economy is at the moment. And that's going to have a big factor to play when it comes to the Treasuries market. And in relation to that as well, the gilts market as well, because they're all it's all about rate differentials now. Who starts cutting rates first, and whether the UK the pound gilts can benefit from a delay or an expected delay out of the Fed if the BOE starts first.
Nora, thank you so much. Nora and Maria, both stay with us. Maria Weitmane, Senior Multi-Asset Strategist at State Street, and Bloomberg's Nora Ali. Now, we're also looking at Lyft pre-market, those shares surging as much as 67% in U.S. extended trading before falling back to earth. Well, I'm not sure about falling back to earth. They're still gaining some 17.8%. The ride-hailing company issued a massive correction to its margin outlook, saying it expects growth of 50 basis points this year, not the 500 basis points in an earlier press release. Now, much more to come, and this is Bloomberg.
The younger generations are more, of course, pay more attention to sustainability, and so they are looking at brands that are greener. But you have to make sure you're authentic because they hate greenwashing. But what is very important to remember is that none of them, whether they're young or not, will ever sacrifice product quality and efficacy to sustainability, which is why part of the big transformation of our R&I, where there's this €1 billion we spend every year, most of it is spent on transforming our formulas from petrochemicals to biosourced ingredients and green sciences, but without losing the efficacy.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
Well, still with us, Maria Weitman, Senior Multi-Asset Strategist at State Street. Maria, thanks so much for sticking around. And we were talking a little bit about where you see the best opportunity. I don't know what you've learned actually in the earnings season. It was a little bit uneventful, which is good news. And some companies in certain sectors really did all they could to just give money back to investors through dividends and share buybacks.
No, that's definitely true. And I think before earnings season, we were talking about kind of stability of earnings, about ability to protect margins. And that seemed to be really differentiating factor kind of post-earnings seasons, and companies who are able to do it. And like you mentioned, dividends and buybacks, those companies tend to do better. I mean, majority of those, as I mentioned, are in tech sector. I mean, a bit of like healthcare, maybe energy looks a little bit better. There are quite like significant disappointments, mostly in cyclical areas. And to us, really important factor has been margins. So margins is a real problem. We see companies, there are bigger sales growth than earnings growth. So margin had been squeezed for companies to be able to kind of generate those sales. So that's a real concern, especially as earnings expectation for the whole year are still double digit. So for us, that's particularly kind of optimistic. So we're really looking for companies who are able to protect their earnings, let alone grow them.
And so, Maria, is that in certain sectors? I know you worry about financials, but you're also looking at healthcare.
Yeah, no, financials, that's our kind of pet hate. Financials, it's interesting that we had last year, arguably was one of the really good conditions for financial sectors. Interest rates were increasing, margins were rising, companies were still lending. And now we see really all those headwinds, all those tailwinds turning into headwinds. Interest rates are coming down, lending is really slowing, provisions need to increase. We see investment banking revenue slowing, so it's really tough times for financials. Like looking ahead, healthcare is almost opposite. Is that they're able to generate strong free cash flows, earnings look a little bit better, and we also know from institutional investors that the positioning in healthcare stocks is really low. I mean, it's traditionally investors kind of shy away from healthcare stock in election years, but I suspect this year is probably elections are going to be fought on quite different agendas other than kind of drug prices. So we see opportunity there.
So, Maria, is there anything else? I don't know how you read China at the moment. So, for the moment they're on holiday, and of course, when it goes back to business, it'll be a good understanding of how consumer behavior has, happened actually in the Lunar New Year.
Yeah, no, I think it's an important point, but I think in general, I mean, Chinese authorities obviously spent all of January and like the back end of last year trying to support market. We had a very difficult performance last year, quite a lot of policy announcements. But I mean, unfortunately for us, majority of those policy announcements were stock market related. So you look at like short selling bans, which ultimately never work, or things like putting more sovereign wealth money into stock ETFs and things like spending like trading hours and northbound connect. So all those things that are stock market related, they don't really address the kind of fundamental problem. And to me, the fundamental problem in Chinese stocks, if you look at last 10 years, MSCI China earnings have gone down 25%, while the rest of the world earnings grown 50%. So that's really fundamental, that companies are struggle to make money, regulatory regime is difficult. So I think that's really not a market for kind of long-term investors to come in. We know investors are underweight, it's cheap, but it's really the policies we heard, policy kind of initiatives, they're really not supporting the real kind of fundamental problems that Chinese market having. So we would stay away. We think it's a trader's market. It's not really long-term investment market.
So interesting, Maria. Thanks so much. Maria Weitmane, their senior multi-asset strategist at State Street. Now, coming up with some of the biggest Dutch companies reporting today, we also look at what they tell us about consumer demand and behavior. We'll discuss Heineken's miss and a beat from our hold delays. That's up next, and this is Bloomberg.
London will stay a financial center. It will stay our EMEA hub. We'll just have a rebalancing onto the continent. And actually, the numbers of who has moved across aren't that big. So it's sort of in the 200 level. And if you think about 15,000 people, that's sort of not that material. And so I do think both will basically continue to grow and continue to be very relevant. What will change, though, and the big thing that's changing, is actually the risk-taking is what's going to move. And so we've historically had risk-taking in the UK. That risk-taking and the assets that go with it, not the people alone, but the assets that go with it, that's the next phase of what we're now moving into. And that will be a material change.
Politics to the world of business. Every weekday at 5 p.m. Eastern Time, hosts Joe Matthew and Keely Lines deliver news, insight, and analysis live from Bloomberg's Washington headquarters. Get the latest from and about politics' biggest power players at the end of every trading day. Balance of Power live around the world every weekday at 5 p.m. Eastern, only on Bloomberg Television. Context changes everything. Bloomberg Surveillance covers the latest in global markets and the political events that influence your world. Join Jonathan Farrell, Lisa Abramowitz, and Anne-Marie Hordern every weekday morning at 6 a.m. Eastern, only on Bloomberg.
balanced revenue growth is important, with a good balance between volume and pricing. Last year, indeed, it was predominantly driven by pricing. That was out of necessity due to very strong inflation on our input cost. We have started seeing that decelerate already in the second half, and much more moderate input cost inflation in the new year. Consequently, much less pricing, and therefore we do believe we will be able to generate more balanced revenue growth.
That was Dolf van der Brink, the Chief Executive Officer of Heineken, speaking earlier on Bloomberg Markets today. And that's as the world's second biggest brewer warns of economic troubles that will weigh on beer demand through 2024. Now let's get more on those earnings from Heineken and fellow Dutch-listed company Ahold Delhaize. Bloomberg's April Roach is in Amsterdam with all of the details. April, good morning. So what can he actually say about current consumer demand based on both Heineken and Ahold?
Good morning. Yes. So, I mean, firstly, looking at Heineken, overall, the company sold less beer last year due to high inflation and challenging business conditions. And if we look at the firm's outlook, it provided a very cautious outlook going into 2024, as it expects that slowdown in consumer demand to continue to weigh on its beer volumes in 2024. So it's expecting those negative trends to continue going into this year. Whereas if we look at Ahold Delhaize, they're also quite a cautious outlook. The company kind of reiterated its historical target for its adjusted operating margin for 2024. Said that it's quite proud of this achievement, that it's able to maintain its guidance and expects a kind of similar performance year on year. So again, as well, Ahold Delhaize, that big sort of retailer, is being quite cautious on its outlook going into the year.
So what can you tell us about the differences in domestic or European markets versus overseas markets when it comes to these consumer-facing companies?
Yeah, so in Heineken, we saw there were some difficult weather conditions over the summer last year that really impacted its results. And for Heineken, analysts were really focusing on how it would fare in its key Asian markets like Vietnam and Cambodia. And the answer, if we look at the results, is that these markets remain challenging. Heineken said that the decline in beer volumes in Vietnam, but also Nigeria, accounted for 60% of those volume declines in beer. So those markets are really continuing to drag on its profitability and remain challenging. If we look at Ahold Delhaize, we know that the retailer has been facing multiple headwinds in the U.S., and that's due to the restart of student loans and also the U.S. government unwinding its SNAP benefits program, as well as high interest rates. So all of those factors combined really put pressure on Ahold Delhaize's margin in the U.S. However, with this 4Q update, we saw that the U.S. market actually performed better than expected, and this was able to help boost results. Also in Europe, Ahold Delhaize said its volumes turned positive for the first time in 2 years. So in both markets, there actually saw some positive.
April, thank you so much. April Roach is there with the very latest on consumer behavior. Coming up, the latest from the Middle East. This is Bloomberg.
How are you feeling right now about the state of the industry and what it's going to look like in the next couple of years?
The big picture is it has never been more, I would say, volatile. I mean, it has, but it continues to be volatile. But like you said, we did see real signs of life this summer. So generally speaking, box office is down globally around 20% to 2019, so pre-pandemic levels. But this summer, it was 5% down. right? So it would suggest that even though there were winners and losers of this summer, and obviously we had the two big juggernauts with Barbie and Oppenheimer, you know, movie-going begets movie-going, right? So when there's a season filled with, you know, good movies that people want to see, you know, I was made to feel pretty optimistic about what we saw in the summer.
From our studios in New York and San Francisco, our expert hosts have the data and analysis about the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action. 11 a.m. on the East Coast, 8 a.m. in the West. Only on Bloomberg Television. Context changes everything. In a multi-trillion-dollar industry, there's a lot of ground to cover.
We indeed have a rally. We're talking a lot of dividends. We're talking income.
We'll show you what's happening in ETFs like no one else. Bloomberg ETF IQ, Monday on Bloomberg.
Well, Wall Street caught off guard as hotter than expected U.S. inflation deals a blow to Fed rate cut hopes. Some relief for the Bank of England as UK prices rise less than forecast in January, with downward trends in food and household goods bolstering bets that inflation could actually soon return to target. Plus, Heineken slumps after the world's second biggest brewer warns that persistent inflation and economic troubles will weigh on beer demand. Well, good morning, everyone, and welcome to The Pulse. I'm Francine Lacqua here in London. So officials in Egypt are reportedly making progress on a ceasefire and hostage release talks in the Israel-Hamas conflict. Sylvia Westall, Bloomberg's managing editor for economy and government in the EMEA region, joins us now. Sylvia, thank you for joining us. You're in London today. You've been following this extremely closely from the very beginning. It's unclear to know where we are. We count the number of civilian deaths, and actually, are we closer to a hostage release?
Well, I think we can talk about this as another kind of tipping point in what's been happening since the October 7th attacks on Israel. Right now, the Israeli military is pushing up towards the Egyptian border in this offensive, and they're planning to enter the southern city of Rafah, which is close to Egypt, and that's where about 1 million civilians are sheltering, and where they've been moving through the Gaza Strip since this offensive started. So I think there's now Israel wants to finish the military operation. Its aim is to completely destroy Hamas in Gaza, and it says that there are battalions that are in Rafah that they need to target and they need to eliminate as part of this. But this is an area where all the civilians are. There's increasing pressure on Israel to slow this, to make sure it protects civilian lives, and also to enter into these ceasefire talks and try to come up with an understanding that means that these hostilities can at least pause to get civilians out.
But there was a big report, I think, from Amnesty International. There was a big report from also the UN. The U.S. seems to be telling Israel to temper down the way in which they pull out these attacks. Are they listening?
I mean, the US and Israel would say that it has been trying to protect civilian lives. The US would say it is having influence. The view from the rest of the region is very different. You've had remarks by Jordan's king. You've had other countries in the region saying that, even Biden himself saying that the military offensive has gone over the top. Netanyahu said he didn't understand what Biden meant by those comments. So I think you are seeing real frictions between the US and its main ally in the Middle East right now.
But how problematic is it for the US? I mean, if they want Prime Minister Netanyahu to stop civilian casualties, do they actually pull aid out of Israel, and would that make a difference?
And that's one thing that some critics of what's been happening have been saying is an option. I mean, right now what we're seeing is that Israel has moved and it's into its last phase of its offensive in Gaza with this end goal, and it's pushing forward. And it's really very difficult right now to. I think that's why the pressure has really increased on these ceasefire talks, and why we're seeing increasing leaks about progress. I think the different sides would talk about progress or not. It's all being mediated by Qatar and Egypt, and it's very very delicate negotiations happening right now. They have had success in the past, where they have had a pause of a certain period of time, but right now I think the stakes are raised on all sides, which is why this particular round is especially difficult.
So would Egypt or other bordering countries actually take some civilians?
It's been really difficult. I mean, there have been suggestions that, Egypt should take in large numbers of Palestinians, but Egypt completely rejects this. It says it's thinking about its own security, its own, peace agreement with Israel, and also that if they do this, then what happens to this idea of a Palestinian state in the future? So I think this idea, is the longer-term thing that everyone is looking at. In some ways, this is a tipping point into disaster, but others might argue it's, it could actually mean that this is an opportunity to actually try to head towards a Palestinian state. But it just doesn't look like the US and others have the leverage to do that right now.
The U.S. also seems extremely uncertain. I mean, they're still sending weapons and money, of course, to Ukraine. And then we had this, frankly, bizarre statement from Donald Trump in a rally saying that actually he would encourage Vladimir Putin to do something in countries that don't pay their dues to NATO. I mean, where will that go?
Well, I think now what we're seeing is U.S. domestic politics affecting, policy in the rest of the world. We often, I work in, look at Russia, Africa, Middle East. We often talk about domestic politics in these countries affecting how they react in the global order. But right now we're seeing the U.S. is having the same issues. So I think right now we're seeing that this debate on Ukraine, on Russia, on Israel, on all these other things, this debate in the U.S. is sort of filtering through to U.S. foreign policy. And Trump, as the front runner, Republican front runner, is really playing into that. And it's an opportunity for critics of the U.S. and critics of others to seize the moment, like Vladimir Putin.
How much is actually happening on the ground in Ukraine at the moment? Is Putin just biding his time in case, Donald Trump becomes president?
Yeah, it's a tricky one to sort of assess. What we know is that we've reported that, Russia's sent some curious signals to the US that it's willing to have talks and discuss certain parameters of what that might look like. US officials say, they reject this. They say nothing has happened of the sort. And they say that, Putin is trying to sow divisions amongst Ukraine's allies. What we can say is that is happening, that there is an attempt to sort of sow divisions. And Ukraine has been dealing with its own turmoil, both domestically and on the battlefield, where things are at a stalemate. So it's a really volatile time right now leading up to the elections later this year.
Sylvia, thank you so much for joining us. That was, of course, Sylvia Westall, Managing Editor for Economy and Government in the region. Now, House Republicans have voted by the narrowest possible margin to impeach Homeland Security Secretary Alejandro Mayorkas after a failed attempt last week. Well, Mayorkas becomes the second cabinet member in U.S. history to be impeached. However, there's little chance that the Democratic-led Senate will vote to convict him and remove him from office. Coming up, Bloomberg understands that Standard Chartered is weighing a major revamp to boost returns. We have the details on this and much more next. This is Bloomberg.
This will probably go down in history as one of, if not the largest financial crimes ever.
I cannot imagine a scenario where $8 billion just disappears.
Bankman-Fried has pled not guilty to multiple fraud charges.
Sam was just too important in the crypto community.
When someone says, I'm going to give $1 billion in the next 2 years, that catches everybody's attention.
As time went on, their ideas got weirder and weirder.
I don't think he even had almost a conception at some point that it was wrong or right. I think he just had the mentality that he has to win.
This committee will not stop until we uncover the full truth behind the collapse of FTX.
So, Mark.
Are you in? I'm in.
I'm in.
We're in. Will this be the last of its kind? No. This is the nature of capitalism. Get over it.
This is Bloomberg News Now.
News when you want it at the touch of a button.
Another volatile day on Wall Street. We're seeing big moves.
All eyes on Capitol Hill as Democrats and Republicans prepare.
Today's job numbers casting doubt on the Fed's next move. Inflation remains front and center. And that's news when you want it with Bloomberg News Now. Get it 24/7 on the Bloomberg Business app, Bloomberg.com, and anywhere you get your podcasts.
Bloomberg News Now. Context changes everything.
Gradually reducing this year from around to 49% to around to 40%. So it will be good that at the same time we will be in the market with our share buyback. They have also said that, again, they want to participate pro rata in our share buyback. So that's also the indication that they stick to their agenda despite having a caretaker government in further reducing the stake in ABN AMRO.
Well, that was the ABN AMRO chief executive there on the Dutch government selling part of its stake via the company's share buyback. Now, the company is one of the biggest risers this morning on the stocks, on the Euro Stoxx 600, after beating estimates in the fourth quarter. Now, Spanish lender Santander says a review into accounts held by an Iranian petrochemicals company has found no breach of U.S. sanctions. The review came after a report in the Financial Times that Iran was covertly moving money around the world using accounts held by Santander and elsewhere. Now, another news, Bloomberg has learned that Standard Chartered is considering restructuring its institutional banking arm. Now, the revamp would be the latest effort by the chief executive, Bill Winters, to improve returns. Now, a spokesman for the lender declined to comment, but Tom Metcalf, who's been spearheading that team, Bloomberg's managing editor for finance and investing in EMEA, joins us now. So, Tom, this is a pretty exciting scoop because it kind of gives it a little bit of an insight on what the chief executive of Standard Chartered could be looking at. So what are his options?
Yeah, exactly. It's what's going on behind the scenes. The bank's obviously preparing for its fourth quarter earnings, February the 23rd. So we're expecting more stuff along these lines perhaps leak out. And this is an interesting option they're apparently considering is right now Standard Chartered has this huge unit, commercial, corporate and investment banking, all headed by Simon Cooper. And what they're apparently, one of the options they're considering is splitting that out a bit, give a bit more visibility in all those business lines. But that would be a big change. As long as I've been covering Standard Chartered, it's had this structure. And it also begs the question of, if they're considering this, what else are they considering?
So what do we know about China?
In terms of...
what have they said about their operations in China?
Oh, yeah, well, big area for them. I think it's kind of gone through a difficult period. In terms of that, they're basically, it's going to be key to their results, right? So they really need the China, the Asia markets to be firing. That's how this bank works, basically. The sense is, if that goes wrong, they really need to look pretty deep to sort of make it work.
So, when you look at earnings, of course, as you say, on the 23rd, a lot of it will be on this possible restructuring. Do they have a valuation problem, given how much money they make? What would be the rationale of splitting up these two groups?
Yeah, no, well, certainly expecting this all to be announced. As I say, they might change. Nothing's been decided, so they might come out with something new. And I think the rationale is, you look at the share price, under Winters, it's dropped something like 40% since he took over in 2015. So you can see why investors might be starting to lose patience. They've gone through now a high interest rate environment, haven't really seen that jump in the share price yet. So the interesting thing for me is this change is not that drastic. It sounds drastic, but it's effectively, just splitting things up within the same overall bank, right? Whereas I think some investors looking at their share price might be pushing for something more drastic.
Tom, thanks so much. As always, Tom Metcalf, they're in charge of finance and investing in EMEA. Now, Lyft shares are rallying pre-market, although nowhere near the 67% surge in extended trading. Well, the ride-hailing company issued a massive correction to its margin outlook, saying it expects growth of 50 basis points this year, not the 500 basis points in an earlier press release. Now, the rival to Uber sees first quarter gross bookings of up to $3.6 billion, beating estimates for just under 3.5. Let's bring in Bloomberg's Alex Webb. Alex, I kind of read it 5 times yesterday. I was like, wait, what? 67% higher for the stock because of a number error.
Yeah, yesterday we were talking about ASML decline because of a fat finger trade, potentially. This kind of looks like a similar thing, actually, with a fat finger on a keyboard. They're attributing it to a clerical error. They said they were expecting the margins to increase by 500 basis points. Half an hour later, they went, oh, whoops, no, sorry, 50 basis points. Clearly, a factor of 10 smaller. It's embarrassing, obviously. Yeah. The share price had this huge boost, and after hours it's come down quite considerably. It doesn't, you know, someone quoted in the story a lawyer saying, it doesn't necessarily look like it's securities fraud, it's a mistake. Humans make mistakes. The stock is still trading up, which seems to reflect the numbers are indeed getting better.
Let's move on to Amazon now. I'm quite fascinated by this because Jeff Bezos has sold a lot of stock. I mean, he sold like $4 billion worth of stock in just 4 days.
Yeah, there's some speculation this is to do with his move to Florida, where the tax in Florida on corporate gains or capital gains, I should say, sorry, is quite a lot lower.
Yeah.
Non-existent compared to Washington, to Seattle, where he was living previously. So this enables him to do that. He's never bought Amazon stock since he's founded the company. With the stock on a bit of a tear this year, a bit of a rally, it's presumably a good moment. He has lots of other things he can spend his money in, not least Blue Origin, which has gone through a few of its own problems, maybe needs some capital. We don't know how he's going to spend the money, but it's, you know, with a company like Amazon, it's a big amount of money for any individual. For Amazon itself, it's a small slice.
NVIDIA also now overtaking Amazon as one of the biggest, you know, market cap in the AI rally. What does it tell you about what NVIDIA does next?
Well, we've got earnings coming up next week, I think, and this is going to be, you know, as ever, with these hugely sort of overbid stocks, like, they need to sort of beat expectations in order to meet expectations, essentially. The expectations are sky high. In fact, if you look at the share price, it's just been consistently overtaking the 12-month target price. Like, analysts just can't keep up in terms of where they think the stock is going to go. They've all been consistently having to upgrade, or feeling they have to upgrade, in order to predict accurately where the company's going. So there are sky-high expectations. We have seen a few instances of where companies have fallen just ever so slightly short. You think about Microsoft a few weeks ago, and they've taken a little bit of a hit as a consequence. But so far, NVIDIA has, you know, since ChatGPT was released a year and a bit ago, it's consistently exceeded what investors are expecting.
Alex, thanks so much. Alex Webb there with the very latest on some of these really great companies that we follow day in, day out. Coming up, commercial real estate going through a shakeout in parts of the U.S., but just how far will the contagion spread? We'll have more on that story next, and this is Bloomberg.
The younger generations are more, of course, pay more attention to sustainability, and so they are looking at brands that are greener. But you have to make sure you're authentic, because they hate greenwashing. But what is very important to remember is that none of them, whether they're young or not, will ever sacrifice product quality and efficacy to sustainability, which is why, you know, part of the big transformation of our R&I, where, you know, there's this €1 billion we spend every year, most of it is spent on transforming our formulas from petrochemicals to biosourced ingredients and green sciences, but without losing the efficacy.
Source for news and analysis analysis covering the biggest challenges facing the UK government, economy, financial services, and markets.
Tax cuts should not be.
Francine Lacqua.
Well, how do you see actually servicing your clients?
It was disruptive, and it's going to have implications to how capital raising works.
Now we're having the perfect storm in the UK.
Watch Francine Lacqua Thursdays at 9:30 a.m. only on Bloomberg. Context changes everything.
This is Bloomberg.
Shares rose as much as 4% earlier after their earnings, setting their operating targets for 2024. Now, the chief executive, Ayman Nezat, told Bloomberg he's confident about the recovery this year, driven notably by the opportunities in AI. Well, he spoke with Bloomberg's Anna Edwards and Kriti Gupta from Paris.
We're seeing now the trough in Q1, and we expect from there to start to see a recovery overall from a growth perspective as we go through the year, with a pretty good exit rate in 2024. Basically setting up for a return to pretty solid growth in 2025. And I think probably that's what the market is appreciating, is the fact that we expect to see the trough in Q1 and from there to see the recovery through the year.
What gives you the confidence in that trough in the first quarter, as you describe it, Ayman? I mean, is this to do with your expectations around companies spending on IT and spending on consultancy? Do you see them more and more willing to do that after the first quarter?
So first, we see our pipeline. We ended up as well with a pretty solid, bookings in Q4. We see the budgets that clients have planned for 2024, the discussion we have with them, and then we see the number of projects that will start or are starting, in the next couple of quarters. That's what gives us the confidence, is we expect the investment cycle to come back. Number of, some industry like financial services have cut to the bone around some of the tech costs, and we see them to, starting probably in Q2, Q3, to start to unlock more budget because they have to make some of this investment to continue their digital transformation. So we continue to see positive traction. And we see new areas, for example, around sustainability. We have developed quite a bit of offerings, and we launched around climate tech last year. And now, for example, we're involved in a number of gigafactory scale-up across the world, not just in Europe. And of course, this is new business that's coming in that will scale over time. You haven't yet opened the subject on Gen AI, but the Gen AI discussion are opening a lot of discussion around transformation across the firm, and which again, setting up for a number of new potential projects that we see coming through the year.
When does all this AI investment, with whichever partners you choose, actually pay off? There's a question of whether this is a 12-month story or a 10-year story. When do we start to see the investment pay off?
So there have been some quick payoffs in some areas. The most worked out example is the famous call center example, productivity, and people have seen, improvement quite quickly. In some others, it's going to take more time, because it's not just about developing a nice algorithm that basically enables you to make decisions faster. Is how you take that at scale in your company. What do you need to change is target operating modeling, KPI, reskilling people, changing processes. So some of it is hard work, but this is also what's going to bring the much bigger payback. We will see, acceleration in R&D development cycle, how to innovate and to be able, to design and produce cars much faster. Same thing around R&D in pharma. There's a lot of innovation around, how do you increase the hit rate around molecules, and how from there to be able to bring, products to market much faster from a drug perspective, and to be able to address, smaller diseases where initially people would not put the money on the table to be able to go after them. So there's many, many areas across the value chain of firms.
Well, that was Ayman Nezat, the Chief Executive Officer of Capgemini, speaking to Anna and Kriti on the back of their earnings earlier this morning. Now, commercial real estate looks to be in crisis in many countries, with blow-ups from New York to Sweden and, of course, Germany. But there are concerns that contagion could spread, putting a black hole into the balance sheets of major financial institutions. Now, European bank executives and even the German finance minister have been looking to reassure investors about the health of Europe's commercial real estate sector.
If I take the global balance sheet of the group, we have around $500
billion euros of real estate exposure, but it's almost only made of home loans to French and European citizens. So it's definitely not an issue of commercial real estate, fancy commercial real estate in difficult areas.
Our expectation is that in this sector, maintaining a strong focus of attentions, obviously, but we do not be in a position to have a negative surprise during 2024.
From all what I have known, the market as a whole is stable. Unless there is a need for new priorities and to rearrange projects due to the higher interest rates.
Well, joining us now is Bloomberg's Jack Sitters, our resident expert on everything real estate, especially commercial real estate. Jack, we've been talking about this for, 18 months, but frankly, it feels like 5 years. So why has it taken so long to actually get here?
Yeah, well, so I guess, unlike most of what you spent the day talking about, real estate is not traded on a screen. Yeah. It's inherently illiquid. It takes months, even years to sell it. So a quick recap, what's happened. Obviously, we had Russia's invasion of Ukraine, interest rate hike, inevitably risk-free rates gone up. Yeah. So returns required from property accordingly go up. And what that means is sellers are clinging to their backward-looking valuations, which are based on previous transactions. Buyers want to pay a new price that reflects where the risk-free rate is. So a huge, big bid-ask spread opens up, no deals. Valuations are based on transactional evidence, so they're very, very slow to adjust. This has been dragging out now, as you say, for like the last 18 months. But gradually, as time goes on, loans mature, people have to refinance, funds hit the end of their life, they have to sell assets, and you get that drip, drip, drip of transactions. And what we're starting to see is those transactions are at materially lower prices than where they were before, understandably. And eventually, banks have to acknowledge what that means is there's going to be some impairment in their real estate loan book. So that's where we are now. Banks are starting to provision for expected losses.
But Jack, so how big are these provisions? Like, again, do we fully have an understanding of the exposure of who to what? Or could it turn ugly quite quickly?
So, no, we don't have a perfect picture. I think, as ever with real estate, it's worth bearing in mind it's an inherently local asset class. And the sort of worst part of the market globally right now is the US office market. Also, the US has the most transparent debt market. So we have a reasonable sense of who's exposed to US office in particular. I guess what's been interesting recently is that's not just US lenders, that's European lenders, Japanese lenders. So there's risk of spread there. What we don't have yet is a real sense of how significant the hit to lenders could be in Europe. We've had individual isolated events. Signa, the big Austrian luxury group, has collapsed. Julius Baer has written off its entire exposure there. But there could be more to come.
So, Jack, is this mainly basically because of the link to U.S. commercial real estate, or is this commercial real estate in Europe that then needs to be provisioned?
So I think there's two separate things. I think a lot of the headlines we've seen in the last couple of weeks have been around exposure to U.S. commercial real estate. And I think, as I said, we have to bear in mind that the operating environment in the US and Europe are very different. Vacancy rates in the US office market are very high. In Europe, they're rising, albeit, but from a much, much lower base, so not the same concerns. But we do know that, bond yields, gilt yields have moved out substantially over the last couple of years, and real estate prices have not yet corrected to the extent that reflects that. Now, will they fully move in lockstep? We'll see, but if they do, inevitably, there is going to be more distress for European lenders.
Jack, as always, thank you so much. This is really the topic du jour. Jack Sitters there with the very latest on commercial real estate. Up next, Bloomberg Brief, Danny Berger and Manus Karani in New York. They'll also be speaking about the energy markets. This is Bloomberg.
been so used to the fact that every time there's a problem, central banks come and ease. This has been the kind of playbook, you know, throughout my career, before that, after I left. Now we're in a very different environment. Central banks actually have to create a recession, in essence, to get back to price stability. So it's a complete reversal of the modus operandi, in a sense, of central banks as they've known it for the last several decades. So that's why it's not so much that they're getting something wrong. They've now acknowledged that there is this trade-off, these costs to pay, but it's a completely different way of thinking about central banks, and it's a different role. Another way to put it is they have to be unpopular now in order to get inflation back down, where it used to be you could count on them each time to rescue you, to stabilize the system, to bring support. And that has shifted, and I think many people, even in the markets, have not quite understood in my mind how much we are now in a different regime compared to the last 4 decades, effectively.
So it's what, almost an easing bias in the markets? How would you describe it?
In the U.S., yes. And I think it's this idea, this almost pre-programmed idea, when there is a problem, i.e. potential recession, central banks will come and ease.
You were offered a money-losing women's basketball team, and you said, I want to be in the other sports as well. Is that right?
Well, yeah, you know, you got to be smart about this.
Why do the biggest names in business choose Bloomberg?
That is a great question.
It's a great question.
Great question. Great question. That's a question I get all night.
Bloomberg, top experts, great questions.
A very good morning from our world headquarters in New York. I'm Manus Cranny.
And I'm Danny Berger. Welcome to Bloomberg Brief. Let's set your agenda.
Inflation jolts stocks and bonds try to stabilize as the red-hot U.S. CPI data dashed the hopes of that early Fed cut.
Wild ride lifts post-market surge fizzles after it said this year's margins will rise by 50 basis points, not the 500 it had mentioned in the press release.
And Democrat Tom Suozzi wins the New York House race to succeed George Santos, narrowing the GOP's razor-thin majority in the House of Representatives. A very good morning. Politics is a dirty game.
What's worse, politics or inflation? What scrambles your head more, Manus?
Actually, the inflation conundrum, but we'll talk about whether we make 3% or 5% on rates in just a moment. But this equity market got a jolt and a shock yesterday. It was the worst CPI reaction day that we've had since 2022. Down went the SPUs and the NASDAQ. The challenge was, of course, the velocity in the bond market. We claw a little bit back, up 0.4% this morning. It was the Russell that took a real bath, down by 4%. So now we're down to 3 rate cuts. Danny will take you through that in just a moment. But some of the idiosyncratic stocks that are worth focusing on. Lyft. Whoever wrote that report yesterday, they've got a very tough job today. Lyft saying that their margins would blow out by 500 basis points, and then, whoops, it was 50 basis points. The stock still had a strong innings. It's up this morning 17%. It was up 65% at one juncture yesterday. Airbnb, I prefer a hotel. But let's have a look at Airbnb because they gave a little bit of guidance. It wasn't that enthusiastic, and the analysts are trying to make up their mind with that at the moment, down 5.66%. We're not going to book as many Airbnbs as possible. When it comes to Europe, it's the booze cruise for the Europeans. Heineken warns that you've got tough business conditions. We're up at 0.3%. But that, Danny, really speaks to what's happening with the consumer. Voting with your euro or your dollar. It's too expensive. I won't buy as much.
Maybe they're getting a break. I mean, the euro's starting to fall. I mean, at least a break if you're coming from the U.S. and maybe want to buy an Airbnb in Europe. But indeed, we are now looking at a bond market that is finally in line with the Fed. All it took was a shakeup from the CPI, 3 cuts priced in, down from where we were a month ago at 7 rate cuts. We're just below 430 on your U.S. 10-year yield. They rose by 13.5 basis points yesterday. Is this now a recalibration, or is it just more volatility? Is this a chop, or is this something different? Europe wasn't spared either. We also saw bonds there sell off in tandem. We also saw the euro head to its lowest level since November. It was lower by more than 0.5% yesterday. Today it is the turn of sterling to take a beating. We are at 125 on your cable rate this morning after UK inflation relief for the Brits coming in at 4%. That is better than expected after yesterday's hot wage data and a little bit of job owning from the BOJ. We blew through 150 on the dollar yen after that CPI report. The top FX official over in Japan, Canada, says authorities are ready to respond 24 hours a day, 365 days a year. So that little bit of job owning takes us back, but we're still above 150. But man, it's that CPI report, it's done quite the thing to bonds. We started in December, this big bond market rally, this euphoria in markets. Look at what's happened since. We have now erased all the year-to-date gains in this bond market. This is the Bloomberg Global Ag. Now, Manus, we're down 3.5%.
Thing of beauty or a thing of opportunity? I like what John Arthur's had to say this morning. First, it was transitory. Of course, we procrastinated about whether inflation and inflation spikes were transitory. Now comes intransigent, and therein lies the beauty of this. It's about the last mile, Danny. It is about traveling from 3%. Well, of course, we didn't even have a two handle yesterday on the headline on the core CPI. It was 3.9%. A lot of people will say this is where intransigence kicks in, even though you'll say to me, oh, it's owner's rent and it's insurance. Great, you keep that side of the trade.
It was surprising, though, the fact that the shelter component was so much hotter. That is not something people saw coming, and it is worrying, and it is shaking up this bond market. So let's get over to Ella Hoya, head of fixed income at Newton Investment Management. Ella, you say it could go to 3%, it could go to 5% in reference to this 10-year yield. So is it 5% next after yesterday?
Well, actually, what we've been saying is we can break both levels, so 5% on the upside and 3% on the downside. And what data has corroborated so far this year, combined with positioning and the very aggressive rate cuts expected from the Fed, has meant that we've had to reprice, as you were just saying. So 4.5% comes to play, and if you like round numbers, potentially 5% is the next target. I mean, that does make us sound quite bearish, and that's not the intention, but I would say the market dynamics are such that we entered with a very bullish bias in bonds, and that's been difficult to sustain as year-to-date returns show.
I'm curious about positioning. We're looking at the JP Morgan survey this morning, Danny and myself. It is the least outright short in over 10 years. So you have a jolt from CPI, which I like what Paul Donovan said. It's hot, it is not hysterical. It just happens to be hot, but it is not hysteria. When you look at positioning, that says to me there's perhaps more velocity to retest the upside when positioning is the least short in 10 years.
Absolutely, and let's not forget, it's an expensive position to hold on the long side because we are still with a yield way below cash and a Fed that may get a little bit shy about rate cuts. So momentum certainly is for pressure on the upside, and we entered this year with a much, much lower duration position than we would typically have in this environment. And it's exactly for the reasons you say. Positioning in this type of market is important when it's extreme, and it's also been corroborated by the Bank of America Fund Manager Survey, which is super bullish risk and very bullish. It has been bullish duration as well. So if you're a contrarian, which we tend to be inclined to be, then it's certainly more potentially more upside here due to positioning.
Jim Reed over at Deutsche Bank says that the soft landing outcome, that's in its ascendancy. That is being fully priced in, and part of what you're talking about in terms of those positioning. But he says, I would say a no landing scenario is underpriced. Ella, what do you think of that? Is it time to prepare for no landing?
Well, look, I mean, we have wage numbers that are supportive of growth. We have employment numbers that have been supportive, and we've only got more evidence of that. And at the same time, we got a bit of a jolt or a reminder, so to speak, yesterday that maybe not all is well in sort of inflation nirvana land. So perhaps we have room here to test that thesis. But the issue is if we do indeed get no lending, so to speak, then bond yields are not going to be here. They'll be way above 5% because we're going to have to talk again about about higher for longer possibilities. Now, I think that no lending is not a high probability case in my mind, and I'd still assign, the famous R word, so I'll mention recession. I still think there is a 20 to 30% probability, which is potentially higher than no lending possibility. But I think for here, what the Fed does, how they handle this recent data prints is going to be very important for the bond market, particularly the long end of the bond market.
So what do you say to Paul Donovan that it's hashtag hot, not hashtag hysteria, and that it is, not that I'm trying to set the two of you up as sparring, but do have lunch in our absence. What do you say to that? Oh, the bulls are going to say, it's a PCE, you're wrong to be focused on the CPI, and it's the owner's equivalent rent, and Danny's nodding there. So what do you say to that argument, which is, it's a one-off, stop being hysterical?
I mean, I agree with not being hysterical, by the way, so I'd say cheers to that. But on the other hand, I would say, look, your sort of 3-month annualized trend in core CPI has been moving upwards for many months now. So that's number one. And number two, the owner-occupied rents were strong in yesterday's print. So those would be the two counter-arguments to that. Now, I'm not an inflationista, so don't get me wrong.
Wonderful
but all
phrase.
I'm saying is about risk-reward. Yes, I have to say that on V-Day, right?
I will also say it's hard not to be hysterical when it's 5 a.m. in the morning.
I'm excited.
It gets to you somehow. At the same time, okay, so here we are, 12 hours or whatever it is, almost 24 hours after the U.S. inflation print. We get UK coming in, comes in lower than expected. Sterling sells off. Yesterday was the euro that got trashed. Is that narrative we had to start this year, that it would be a synchronized rate cut? Do we need to re-examine that?
Absolutely. There's a lot of dispersion in terms of what's going on with inflation dynamics, labor market dynamics, as well as growth dynamics. But yet the rates markets were pricing more of a synchronized move, as you say. Now, look, I think broadly speaking, that would tend to favor the dollar because the U.S. seems to be doing on its own much better than the rest of the world. And this is why in an environment where inflation prints lower, cable takes a bit of a dive because it does give the Bank of England a bit more room to ease policy on a relative basis. And actually, we've been sort of neutralizing our positions in sterling and increasing our positions in dollars. Dollars we continue to like, I should say, versus the European pairs, where there's still some pressure on the inflationary side. Maybe the UK less so than Europe, but broadly speaking, it shouldn't favor European currencies in our view, at least over the next 3 to 6 months.
We're going to take a left-hand turn because I got to the bottom of your page and you went, dollar yen, actually yen may be an interesting currency to own this year. Well, you and everybody else have tried to own yen this year, and presumably you and everybody else has gone to the bar on a Friday night and went dashed again by that verbal intervention, and there is a real risk that they're going to put another heavy load of intervention in here verbally. We broke 150, it got trashed yesterday. Why would you buy yen? Because you must believe in a greater thesis than the rest of the market, so put it forward.
Well, I think I'm not even going to mention the valuation argument because every man and their dog knows it's probably the cheapest currency, not just in G10 space, but across the board. So it's extremely tempting for the contrarians like myself. But also we have quite a big difference now. In this new Bank of Japan governor, we have much more steady communication and predictability, I would say. And therefore, they've been signaling to the market that they're moving towards away from negative rates or ZERP or NERP, whatever the acronym is. And therefore, if they do, the setup is such, with such a steep yield curve, that you have very good conditions for some repatriation of money back home. Certainly now that it's difficult for Japanese-based investors to own foreign assets and sort of garner the types of returns they're accustomed to over the last 10 years. And so I think the setup is beautiful to get that kind of yen rally, but I think it's going to take months and months and months, and I think you need to be patient. But also, if you have a global portfolio, you can take lots of bets, right? So you're not just taking one bet on the yen. Mm-hmm. I just think it's a really interesting one to watch and pile onto as the conditions, warranted. And I think we're probably in that journey. I think it might take a couple of more months, but I personally think it's a good macro trade for this year.
Ella, we thank you for being with us. You're not an inflationist. We got that message, but you are brave on the yen. Ella, thank you very much. Ella Hossa from Newton asset investment management. Other stories trending on your Bloomberg terminal this Wednesday morning. According to official counts, Indonesia's defense minister Prabowo Subianto is set to win enough votes in the presidential election and lead Southeast Asia's largest economy after 2 failed bids. The former general has nearly 60% in the ongoing quick count.
Shares of Heineken falling as the brew warns that persistent inflation and economic worries will weigh on beer demand in 2024. Heineken CEO spoke earlier on Bloomberg.
Very importantly, we see moderate but sequential improvement in our volumes as inflation is starting to come down and consequently the need to take pricing. We had double-digit pricing in the first half last year, high single digits in the second half, and we see pricing further decelerating into the new year, and that for sure will help the volume momentum of the business.
And Bloomberg has learned that Standard Chartered is considering restructuring its institutional banking arm. The revamp would be just the latest effort by the CEO, Bill Winters, to improve the bank's returns. Sources say the lender is weighing options, including separating the investment bank from its corporate and commercial banking operations.
BP and ADNOC have agreed to form a joint venture in Egypt to focus on natural gas. The move gives the United Arab Emirates a production foothold in a country that supplies the fuel to Europe. Manis.
Coming up on the show, we're going to discuss politics of energy. Canada's Natural Resources Minister joins Danny and I in just a moment. Jonathan Wilkinson.
And we're going to get more on that Lyft story. We're going to speak to Dan Ives about, oh, I've already spoiled it, but a company's earnings call he called a black eye moment. Yeah, it was Lyft. We'll discuss that here on Bloomberg.
This will probably go down in history as one of, if not the largest financial crimes ever.
I cannot imagine a scenario where $8 billion just disappears.
Bankman-Fried has pled not guilty to multiple fraud charges.
Sam was just too important in the crypto community.
When someone says, I'm going to give $1 billion in the next 2 years, like that catches everybody's attention.
As time went on, their ideas got like weirder and weirder.
I don't think he even had almost a conception at some point that it was wrong or right. I think he just had the mentality that he has to win.
This committee will not stop until we uncover the full truth behind the collapse of FTX.
So, Mark.
Are you in? I'm in.
I'm in.
We're in.
Will this be the last of its kind? No. This is the nature of capitalism. Get over it.
Welcome to the world of decentralized finance.
You can see the massive gains for the OG crypto coin.
The breakout we have all perhaps long awaited finally realized. We'll see if it sticks.
Bloomberg's covering all things crypto, the people.
There's no question this industry is composed of some bad actors and some good actors.
The transactions.
Volumes have surpassed $24 billion per day.
And the technology.
Stop talking about the technology. Start demonstrating the utility.
Bloomberg Crypto, Tuesdays.
This is Bloomberg Brief. I'm Manis Craney alongside Danny Berger in New York. Now, at the end of last month, the Biden administration halted new approvals of U.S. LNG exports in order to study its effects on climate, economy, and security. It won praise from climate activists, but the air from the energy companies whose projects are likely to face disruption. Joining Danny and I now on the energy outlook in North America is Canada's Minister for Natural Resources. It is Jonathan Wilkinson. Jonathan, good to have you with us. Minister, good morning. So here we have, some would say, a very political move by the Biden administration. I know it's in the future, these pauses on LNG export licenses, but you as a nation are joined at the hip with the United States when it comes to LNG. How injurious can this policy move be by the administration? Do you think it will endure? Good morning.
Good morning. Well, I actually welcome the pause that the Biden administration has put on liquid natural gas projects for the purpose of actually ensuring that they are looking at it in the context of the commitments that the United States has made to fighting climate change alongside other countries around the world. We have actually done that in Canada over the last number of years. We've put in place measures to ensure that any LNG approvals actually must be consistent with Canada's domestic climate plan and must fit in the context of an overarching view about how we're actually, displacing heavier hydrocarbons in other jurisdictions. So I think what they're doing is the right thing. But I would say, we sort of applaud it because they actually are following in the footsteps that Canada has actually.
Well, Jonathan, there have been, though, climate groups who have said that Canada hasn't gone far enough, that you say the U.S. is following Canada, but they would argue that Canada needs a pause, too. So if the U.S. is saying it undermines domestic energy security, raises consumer costs, and damages the environment, if that's true of American LNG, why is that not true of Canadian LNG exports right now?
Well, I mean, the Biden administration has said they're going to look at this in the context of the climate commitments that they've made. As I've said, we've done that. Like, we're the only country in the world that has put in place regulations that actually require 75% methane reductions in the upstream in terms of the production of natural gas. We are one of the only countries in the world that actually effectively requires the liquefaction of natural gas using clean electricity and not natural gas, which eliminates much of the emissions. And we actually look externally in the context of what is the LNG going to be used for. If it's not being used to displace coal, then it's being used to potentially displace future renewables, which doesn't help us at all from a climate perspective. So we have been looking at it in that context. I think the other thing I would say is, if you look at the work of the IEA, and that includes the communique that came out today, increasingly there is a lot of skepticism about how many more LNG facilities are going to be required, and the risk of stranded assets is a real one. And I think it's incumbent on the United States to have a hard look at that.
Well, the other argument would be is that LNG is going to be major part of that transition fuel in the energy transition. That's certainly what we were told very clearly at COP. Let's move the conversation along to policy, your area, because I'm drawn to the president and the CEO of the Canadian Association of Petroleum Producers. You may know her. She's a feisty lady. She holds nothing back. Lisa Baton really leveraged the hell out of this move by the USA. So I want to know from you, as the minister responsible, then, how would you leverage the hell out of this move by the US? Will you affect policies that will enable and grow the LNG? I know it's going to be we're compliant in every way, but is this your moment to leverage the hell out of a policy made in the USA?
Well, I would say there is some opportunity. I know Lisa very well, but I would say that you've got to bound the opportunity. So the American pause to look at things in the same way that Canada has already been looking at them does create some opportunities for Canada. But part of that is about opportunities for countries that have taken action to decarbonize the production of oil and gas. And Canada actually has led in that regard. At the end of the day, in the transition, those fuels that are actually produced with very low carbon emissions are going to be valuable. But the transition one has to be very clear. The transition has to be a relatively short one. I mean, if people truly believe that we are going to achieve net zero by 2050, which is what we have all committed to under the Paris Agreement, you actually can't have unabated combustion of natural gas in power plants in Japan and South Korea, et cetera. So we have to be thoughtful about the timeframes here. Okay. And it is not good enough for people to wave their hands and say somehow natural gas contributes to fighting climate change without thinking about the time at which it actually has to stop emitting.
Well, Jonathan, all these plans are well and good, but we have to face the reality on the ground that in the U.S. it is an election year. It is in full swing. The polls all point to a Trump GOP nomination, and he leads in the national polls, too, for the presidency itself. For your policy, for Canadians' energy policy, what is the biggest threat of a Trump presidency 2.0?
Well, look, I mean, Canada does enormous amounts of trade with the United States. We need to work with whoever is the president of the United States. I think there is lots of trade in energy and in oil and gas, but in hydroelectricity and a range of other things that goes on right now. Certainly, I think the Biden administration is probably closer to our perspective in terms of climate. But we also worked with the Trump presidency before that. At the end of the day, even if there is not a continuing commitment to fighting climate change at the federal level, there are lots of states that continue to do that, and we worked with them when President Trump was in power before. So you know,
that's
we
where
are going to.
That's where you would lean then, Jonathan. You're hoping that the states, if Trump's in the White House, it is the states that will continue. Do you see the risk of a Trump administration 0.20, as Danny says, something that threatens the world goals, the COP28 goals to decarbonize? I mean, everybody needs a recovery plan or an emergency plan. What's yours in terms of challenging a Trump administration on those global goals?
Well, certainly it is helpful when the Americans are pulling in the same direction as the rest of the world under the Paris Agreement, and you know, it's more challenging if the United States essentially decides to withdraw, which it did previously before the Biden administration came to power. That being said, there are lots of activities that are going on in states like California and New York and a whole range of others that are pushing forward on the climate agenda. But I would say a lot of this is just being driven by straight economics and by the financial markets. Like when the IEA says that oil, gas, and coal utilization is going to peak this decade, that is based on the data that shows that actually much of this is becoming uneconomic for a whole range of different reasons.
If you look at, Minister, if you look at something like that's not just purely economics and it's more policy, EVs is a great example of this, of what's been built up in the U.S. due to the Inflation Reduction Act. Now, Trump has said that he would look at repealing some of the environmental policy within the Inflation Reduction Act. I know Canada wants to establish a North American EV supply chain. Do you worry about EVs in a Trump presidency?
Well, look, again, EVs in part are driven by regulation, both in Canada and in the United States, but they're driven at both federal and provincial or federal and state levels. I would also say that the automakers have already made significant investments down the EV path. So it may be that some of the changes in a different administration might slow down the progress somewhat, but it's not going to stop it. And at the end of the day, yes, we have aspirations to be part of the electric vehicle supply chain, including critical minerals. That's going to continue, and I think that the progress of EVs will continue in the United States, irrespective of the regulatory sort of imperative that may or may not continue to exist.
Jonathan, just very briefly, you promised a lot of reform to deliver on that EV ambition in terms of mining for critical minerals. It's not going according to plan. Very briefly, where are you on delivering significant reform? How quickly will that be delivered? In 30 seconds. Sorry to press you on the time.
Not at all. We actually released something a couple of weeks ago with some high-level things, but we will be releasing a much more detailed plan in the coming months, and I think you will see some pretty concrete actions to help expedite some of that work in a manner that is consistent with environmental sustainability.
Minister, we really appreciate your time. We have a lot more we could have asked, but unfortunately, that's all we have time for. Jonathan Wilkinson, Canada's Minister for Natural Resources, join us. Manus, some quick breaking lines on UniCredit. UniCredit is going to boost their bonus pool by 16%. They had just had a record year. Good news for employees. They get a higher share of that because of last year's job reductions.
So if you're working at Barclays and you're a junior banker, you're grand, but we know that the investment bankers maybe want to pitch their CV into UniCredit. Lower ranking employees will see the bigger gain than the risk takers. That's quite interesting. So that's about retention in the ranks, isn't it? This is Andrea Orchel running the bank, of course, and paying up and looking large.
Yeah, it's a great differentiation between them and Barclays to make, and I think maybe a painful one for Venkat over there.
Lake Garda or Canary Wharf, you choose.
And so I think what you're going to see in this environment is the appearance of a different and new equilibrium state. It's very scary because obviously investors value predictable, profitable growth. There is no predictable, there's hardly any profitable, and there's hardly any growth. And so how do you actually make decisions? You go revert to what you're used to. And I think that's going to be very interesting. In uncertainty, there is no signal. Uncertainty is about unknown probabilities. What you can do is resolve it, which is take some steps, do some experiments, and if it actually resolves and it turns out it's going here, then be the dominant player there. So I'll say those are all the ways in which we see in health, but also in the scientific world, uncertainty is an opportunity. Last thing I'll say is that in dramatically changing times, that's when new technologies have a slight crack to actually matter. E-commerce, certainly AI now, many of the vaccines. So if you think about it, the technologies underlying the mRNA vaccines existed for 10 years. But the moment in which it actually became possible to do this at a global scale actually was as a result of crises. And the question is, what opportunities is the climate going to present? What opportunities are these current moments of massive shift going to present? And I think that's where entrepreneurs and innovators have to realize this is not the time to actually retreat. This may be a once-in-a-generation opportunity to have the ability to matter.
DOJ or other authorities
could face bigger challenges next.
Was going to keep rain World Cup. This is a 3
as the economic picture.
Covering the intersections of Hollywood, Silicon Valley.
Welcome back. It's Bloomberg Brief. I'm Menace Cranny in New York.
And I'm Danny Berger. Here's what you need to know.
Inflation jolts. Stocks and bonds try to stabilize after the red-hot U.S. CPI print, dashing the hopes of an early Fed cut this year.
Wild ride lifts post-market surge fizzles after it said this year's margin will rise by 50 basis points, not the 500 it mentioned in the press release.
And the Democrat Tom Swayze wins the New York House race to succeed George Santos, narrowing the GOP's razor-thin majority in the House of Representatives.
Manus, it's not hysteria. If you thought it was hysteria, it's not. That was according to Ella Hoya, who we were just speaking about in this bond market. We do give some back, which we had in yields. We're down by about 2 basis points after they surged 13.5 yesterday. This market is just now pricing in 3 rate cuts in line with the dot plot after that CPI coming in hotter than expected. The OER, the owner equivalent rents, that was the big shocker in that report. Sterling weakens this morning. We're 125 on cable. We had hotter wages yesterday for the Brits, but relief today. Inflation comes in less than expected for the UK. The euro also got trashed yesterday, trading at its lowest since November. Meanwhile, we have some verbal intervention. The top official for FX in Canada saying, we stand at the ready to intervene in this market. Manus, we blew through 150 yesterday after that hotter CPI report. What did Ella say? She likes to be the contrarian, and this is going to start to look attractive in the coming months to jump in to the widowmaker trade.
Yeah, she's not an inflationist. As I don't know why you're having to go with the Brits. You're a Brit yourself now. You got the passport.
I was complimenting them.
Yeah, you capitulated. S&P 500 took a bath yesterday, down 1.3%. It's hashtag hot, or is it hashtag hysteria, the reaction in the bond market and the equity market to that CPI print yesterday. It was a truth and reconciliation moment, whatever way you look at it, because stocks dropped, those yields popped. You also had some individual names. We'll talk about this with Dan Ives in just a moment. Lyft, I mean, how to get it wrong. Whoops. 500 basis points of a margin increase. No, sorry, 50. So the stock, ramped 60-odd percent, 65%. We're still up this morning. It's still a strong set of numbers. Does Dan Ives believe in that? Airbnb warned that we may not just be as aggressive in our booking. And so the stock's taking a little bit of a pop this morning on the downside, down 5.6%. NASDAQ is fundamentally going to be challenged in terms of where we go in these rates. Ella Hoya, as you said, says it could be 5% rather than 3% first. And when it comes to beer, well, you're voting with your feet in Heineken. I mean, the stocks in Europe are up 0.3%, but Heineken is drifting lower this morning, down by 5.5%, because customers, this is a shock, Danny. The prices have gone up, they're buying less. If the prices go up, vote with your euro, vote with your dollar.
I thought beer was supposed to be the like cycle-proof thing, that no matter what happens in this economy, we're happy to drink plenty of beer. I suppose not. Wait, Manus, I also want to hear, what were the hashtags again?
Hashtag hot. is not hashtag hysteria. That is Paul Donovan. Got to give it to Donovan. He does send out a good note.
I like, it's a trendable moment, Manus. The kids on social media will love it. he's very
I don't know where to go with that.
He's very
Am I
skeptical.
still a kid? Hashtag hot.
Hashtag. Okay, I'm going to move on from this.
Okay, let's move on to Lyft.
Let's talk about Lyft, another trendable moment. Shares of Lyft, a roller coaster ride. An earnings error led to a surge of 67% the after-hours trading, just to fall back down. I mean, it's still up decently this morning after the company corrected it. Dan Ives of Wedbush wrote into Bloomberg saying that it was a black eye moment, and he's never seen an error like this in his almost 25 years on the street. And Dan joins us now. Dan, is this a sackable offense? Does someone need to go over this?
We should go for the kill.
I mean, look, this was an episode out of Saturday Night Live, except it was real. And I think that the scary thing here is just that it actually got through. And I think it's been really a comedy show that we've seen at Lyft for years right now. And this is, even though it was a good quarter, it overshadowed by another black eye moment for Lyft.
Who should take the fall for that? I mean, should somebody take the fall for that? We all make mistakes. I'm infallible, of course.
Of course.
But we all make mistakes. But who should take the ramp for that? Because you get a stock ramping by 67%, still up 17%. Somebody's got to take the hit for that, and there will be litigation.
Yeah, of course. I mean, that's going to happen. And I think that the shame here is that it does take away from what was a good quarter. But look, something like this can't happen. And I think when you look at it and you look at the history of Lyft here, it's been something that the street credibility's been an issue.
Will you call for somebody's head?
Look, I think here it still needs to all play out in terms of the whole process, but when a pilot lands at the wrong airport, that's not exactly confidence.
No. Okay. So not exactly confidence. Won't say whether someone should go or not, but I'm getting sort of a hint here. Look, the other thing we saw yesterday, perhaps some better news, was NVIDIA overtaking Amazon in market cap. Just looking at what the street's done here, some of your peers, UBS, Mizuho, Morgan Stanley, Bank of America, and Goldman all had to hike their year-end targets. We're in this moment of catch-up. But if you're an investor and you're not already in NVIDIA, have you missed the boat?
I don't believe you have. I mean, in our view, this is one, when you think about 3 trillion, some other, targets, there's no reason that this is a company still in the early innings because the AI revolution's playing out. This is the biggest tech trend since 1995 in terms of 30 years. And it's who's leading it? It's the godfather of AI, Jensen and NVIDIA, along with Nadella and Redmond. And now this tidal wave is coming. We expect next week, whatever the knee-jerk reaction is, this is going to be just another massive quarter that shows monetization of AI. It's here.
What is holding us? I mean, there's nothing holding this stock back. But when you try to project forward, I mean, if you look back at Apple, if you look back at Amazon, if you look back at the infancy of those equities, we've passed that point with NVIDIA. So what is it that you need to see to believe that they can't be touched? Because that's what drives unique valuation.
It's all about the order flow and everything we've seen from Asia. I mean, it's going to be another get the popcorn ready, jaw-dropper moment from the godfather of AI next week. And I think what's important there, it's not just NVIDIA. You look at the broader tech sector. Look what we saw in Microsoft. Look what we saw from the Messi of AI Palantir last week. It's all just starting this tidal wave of spending.
I love that. I want to know who the Mbappe of AI is. Like who's getting traded around. I think that's a metaphor too pain to try to do that one.
Look, but this is and that's why we are just starting in what I believe is a revolution in terms of spending.
So, but this is still the picks and shovels that are benefiting the most, the NVIDIAs of the world. I'm drawn to Cathie Wood last year, who, when criticized for missing out NVIDIA, says it's going to be about software. Software is the next bet. Is that right, or is it still where in picks and shovels land?
Well, no, I think right now we're hitting software because you look at Microsoft, what we saw in Redmond, Palantir, MongoDB, Snowflake, Datadog. I mean, we're now starting to see. And then you look at Salesforce, Adobe, the rest of tech. And I think now we're really going from chips to software. That's going to be front and center.
You talked about, what's happening at Microsoft. When you look at this AI story, I mean, ARM's flying higher, but they actually produce the technology that goes on the chips. They're not actually producing, let's say, the collaterals, the CapEx-heavy collaterals that they're going to use. So you've got NVIDIA at the top of the pile, but then you've got Google, you've got Apple. Who else has got the strongest AI? It's Microsoft, Google. Who else comes close to that kind of slipstream of NVIDIA on the AI front in Europe?
Look, I think from a use case from a software, we've talked about Palantir. I think that's the best pure play AI from a use case perspective. But I do think some of the names that are not being given credit, it is Alphabet. In terms of Google on the GCP, we think that could add $25, $30 per share, as well as what's happened at Amazon. It's just started. Now, of course, leading this is what Nadella, the tactician's done in Redmond. But this software piece is just starting. That's why even when you look at cybersecurity, look at names like Varonis, look at the double table pounder Palo Alto, Zscaler. I think this is really, in our opinion, going back to last fall, saw the new tech bull market, despite the bears just peeking out of their caves yesterday, coming out of hibernation mode.
I love that. Peeking out, maybe say, no, I'm going to, I mean, if I was a bear, I'd go back to sleep right now.
Well, they just got frightened by a 10, 12 basis point move in,
but it's remarkable.
In bond yields.
But it's remarkable to see NVIDIA do okay in that, to do see ARM do okay.
But that talks about the resilience. That then talks about the resilience of this overall sector. Everybody's saying, oh, higher yields will kill the tech rally. I presume you'd bet against that. And
go back to a year ago, many that have went down that path, that was the nightmare path in terms of the Fed, that old inflation, it's a soft landing, Pillsbury Doughboy soft landing, we're bullish on tech.
And now I'm hungry, thank you, Dan. So year to date, Mag 7 up 8.4%, but there is a standout in that to the downside, which is Tesla, down 26% year to date. Is it time to start talking about Mag 6 instead of Mag 7?
Well, look, I mean, it's no doubt it's a moment of truth for Tesla, but we view it, it's just, I still view it as the middle of a massive growth transformation with AI and a sub $30,000 vehicle on the other side. But it's been a confluence of things. I mean, the Delaware issue, Musk, the 25%, of course, the margins. But we believe most of the price cuts in the rearview mirror. I think they will navigate. We've been here before. They will, again, be part of the Mag 7, although this is definitely, you know, turbulence that we're seeing go through the name.
Do you really believe, I mean, we compiled a lot in that one statement, so let's just break some of it down. Obviously, Elon Musk wants a bigger equity control of Tesla. A, should he be given it? B, what is my risk today as an equity holder if they don't? His $55 billion pay package has just been blown a hole in it in Delaware. He wants control, or else he's throwing his verbally, and I'm paraphrasing here, he wants more voting power, and he's made veiled threats to walk away. What's my risk?
Yeah, well, I mean, the Delaware decision continues to be a head scratcher for the ages. They're going to leave, in my opinion, go to Texas in terms of incorporated.
Right.
They're going to supersede the 2018 comp package. They will, in a new package, in terms of incentives, get him to the 25%, I believe, at the shareholder meeting. And look, Musk is Tesla, Tesla is Musk. The hearts and lungs of Tesla. And I believe he's worth 60 or 70% of the value of Tesla, so he will stay. And I think the big thing here is the AI initiatives. When you look at Optimus, Dojo, full self-driving, autonomous, you want that under Tesla's hood. Look, I think right now, the New York City cab driver is bearish on Tesla. I think there's a lot more upside potential here as they navigate this.
Dan, I gotta ask you, have you bought an Apple VR headset yet? Are you one of the people on the subway just sitting there doing this?
I did, and I believe it's one where even myself, I think it's when you look at the technology, despite what Zuckerberg's saying.
Did you see the Zuckerberg Instagram?
You know,
he was compare and contrast the products. Go on.
It's apples and oranges in terms of what Apple's done. I think you look at Vision Pro, we believe 600,000 units now. Originally, that was 300,000 units for the year. This is going to be the start of what we view as a renaissance of growth from Apple, not just on Vision Pro, but the AI story now coming to Cupertino.
What's the next AI evolution for? I mean, you've decried the China story, holding back Apple. You've got a $3 trillion valuation on it. So what's the next AI evolution for them?
I think the AI App Store introduction that we expect, that'll be the start in June of WWDC. I'm sure Gurman will be talking about that as well. And then iPhone 16. We believe they'll have proprietary AI in the actual phone. That's going to start just this massive upgrade cycle. We think a year from now, there's a $4 trillion market cap.
The design team, though, has had a huge shakeup. Bart Andre, who joined in 1992, just left Apple. Do they have a talent issue?
Oh, I mean, the talent there is some of the best talent in the world within Apple Park. That's one company I don't worry from a talent perspective. And it just shows right now, this is one yet it continues to be bet against, just like Mahomes, and it continues to prove it out again, Apple.
Dan, you've just gone from a 3 trillion valuation to a 4 trillion valuation in the space of 2 conversations. One I had with you at Christmas time, and now you're knocking out 4. Just run that past me again.
It's AI. Because now, when you think about AI, we believe starts with the App Store, then you go to iPhone 16. A year from now, we're sitting here. You might be wearing this jacket.
I want that jacket.
No.
That's
a year
the
from
future
now, you might be wearing this jacket, and we're looking at a $4 trillion market cap.
I'm taking Manus to Brooklyn so he can get his jacket painted like that. I've decided.
Do you think I could do this show in a jacket like that?
I think you definitely could do it.
I think it's a mistake that you haven't been Manus. I think that's actually the correct answer.
Yes, I think that.
You got to see the sneakers. The sneakers are pink as well, but we put that up. We'll put that in Instagram. You can see the pink. There you go. A little peek at the sneakers. Dan Ives, the trendiest analyst on the street.
It's New York Fashion Week here on Bloomberg.
That's us.
And Valentine's Day.
Happy Valentine's.
Yes,
Happy
you
Valentine's
too.
Day to all.
Dan, thank you so much for being with us both. Great conversation there. That is Dan Ives, our guest this morning from Wedbush Securities. Coming up, with the biggest snowfall in 2 years, New York voters went to the polls to elect who would take over the House seat from George Santos. Who won? We'll take you through the stats. That's next on Bloomberg.
Nobody brings you top names like Bloomberg.
The point is that the economy is doing very well in the Netherlands, but the election was very much focusing on migration.
They had made 26 attacks. We'd given warning after warning, but we hadn't taken action.
Parliament has to stick to this. It has to comply with the debt brake. The debt brake is really a good ally.
I think we have made addressing inequality a key sort of driver of our policies.
Bloomberg. Context changes everything.
How are you feeling right now about the state of the industry and what it's going to look like in the next couple of years?
The big picture is it has never been more, I would say, volatile. I mean, it has, but it is continues to be volatile. But like you said, we did see real signs of life this summer. So generally speaking, box office is down globally around 20% to 2019, so pre-pandemic levels. But this summer, it was 5% down. Right, so it would suggest that even though there were winners and losers of this summer, and obviously we had the two big juggernauts with Barbie and Oppenheimer, movie-going begets movie-going, right? So when there's a season filled with, good movies that people want to see, I was made to feel pretty optimistic about what we saw in the summer.
Stop running around for Trump and start running the country.
Well, that was the New York Democrat Tom Swayze, who won the race to replace George Santos. Now, his victory flips the district in Long Island back to the Democrats and narrows the Republicans' already slim margin. Joining us now is Bloomberg's Ros Matheson. Ros, good to see you. So how much of a bellwether could this be for the mood in November?
Well, certainly it's going to be cast by both parties as a bellwether, both the Republicans and the Democrats. The issues around immigration that are playing nationally, of course, immigration, but also abortion, the economy to some extent, foreign policy, especially the issues around Israel, but not really the biggest thing that people tend to vote on in national elections. And Republican candidate was really pushing on the immigration theme there. But obviously, you know, Tom Suozzi, he held that seat previously for 3 terms. He's got his own brand very much in the area. So there's not necessarily that direct line between what's happened in this election and what could happen in November. He's a known quantity in Long Island. He also outraised his Republican candidate 3-1. He spent more than $13 million all up in the campaign. So the read-through nationally is there, but it might be limited.
But now we have an even slimmer majority for Republicans in the House. What does that mean going forward?
Well, it does mean, of course, everything's going to be even more obstructed and difficult in the House than we've seen already. We've seen so many examples of legislation that's been tangled in the House in recent months, including aid for, obviously, Ukraine, Israel, and the border deal, which got torpedoed primarily because the presumptive Republican nominee for president, Donald Trump, said that he didn't think Republicans should support it. He obviously said, if that deal happens, in a way, it's a gift for the Democrats. So he's trying to slow all that down. So what we're just going to see really in the run-up to November is pretty much gridlock in Congress. Nothing much is going to get through. If it gets through the House, it won't get through the Senate. If it gets through the Senate, it won't get through the House. And they're all just trying to obviously play on these themes again, immigration, the economy, and so on in the run-up to November.
Tell me this, obviously we've got this impeachment vote ongoing, you know, how does the House vote on Mayorkas? Does it play into those themes, or how significant is it?
Well, very much it plays into those themes. As you said, the vote to impeach Homeland Security Secretary Alejandro Mayorkas. That's the first cabinet member, in about 150 years. So it's symbolic in some ways, but obviously the Senate's never going to vote to convict him in this. What this does is just create a debate again in the Senate. It's going to allow Republicans a platform in the Senate to talk extensively about these issues around immigration, particularly to draw the direct line to Joe Biden and his policies on it. Because as we know from a poll we conducted recently, you know, in 6 out of 10 swing states, voters directly blame Joe Biden for failures to address what they say issues around immigration. So what this does above all is just give Republicans a further platform to beat that drum on.
Roz, thank you very much. That is Bloomberg's Rosalind Matheson. That vote happening after everyone. But I still can't believe, Manus, that was the biggest snowstorm in 2 years for New York. That was nothing.
I came prepared. I had my boots from Davos last year. I had this big blancmange. If you saw me yesterday in New York, actually, I was like this blancmange with a little.
But did you need
cap.
it? Were you walking through the streets of New York and saying, "I'm glad I wore this"?
I was hiking through Chelsea. I was industrially moving through
hard.
Chelsea. Life is hard. Why I booked an appointment in the middle of a blizzard, goodness only knows. But we got there. I like the boots.
Yeah, I like them too. I definitely like them too. Okay.
Have a look at my Instagram. Shall we have a shameless plug? Yeah, have a look at my Instagram. You can see the boots and the coat. Fashion icon.
He is a fashion icon. Okay, man is coming up. I'm moving on. He is. Look at his Instagram.
She's moved on without me.
We're going to look at some of the market moving events for you to watch throughout the day.
timelessness and sustainability go together, right? You can't expect to be timeless if we're run out of resources. So for me, sustainability is not a side activity. It's not a reaction to external pressure. It's core to who we are, what we stand for. And to a very strong extent, it's about future-proofing our business, right? You need to focus on sustainability to recruit. More and more, that younger consumer we're talking about, they want to work for companies that care about this planet, that do more than just kind of generate revenue and profit. You need sustainability to attract consumers. More and more, including that younger consumer, they care deeply about what are you doing differently? How are you making a difference? Investors, particularly in Europe, more and more place value on what you're doing in sustainability. Many of our partners have expectations on sustainability.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
It's Bloomberg Brief, Danny Berger and Manus Cranny in New York. Okay, let's get you set up for your trading day. Here's a look at what's ahead. We're going to hear from Fed speakers. That includes Chicago Fed President Austin Goolsbee at 9:30 a.m. Eastern. Then it's the turn of Fed Vice Chair for Supervision, Michael Barr. That's at 4 p.m. Eastern. And then more earnings, Cisco, Occidental, and TripAdvisor all after the bell. Let's hope they all have their statements in order and don't add any extra zeros anywhere, Manus.
I mean, that is mind-blowing. We're talking about Lyft, of course, yesterday, which is one of the micro movers this morning. The stock ramped 67% yesterday on the back of adding an extra zero to their margins. Still up 18% this morning. We just had Dan Ives really saying this is, this has been a sort of a random walk organization since the start. He's been hypercritical of the running of this organization since the start. Airbnb is down 5.65%. Danny's come to live in America. There will not be the same level of bookings at Airbnb. They're just tentative about the outlook, so the market takes a little bit of a hit. And Instacart down 3% after reporting fourth quarter revenue that missed expectations and job cuts. I haven't used Instacart yet.
Neither have I. I barely figured out how to grocery shop here. But, man, it's the thing on Lyft. I was thinking about Dan Ives saying, because, I mean, the stock is still up 17% this morning, right? But he was talking about how it scarred Mars and what would have been a really good quarter. I mean, you got to feel bad for maybe not the person who made the mistake. Maybe you feel kind of bad for them.
It's like the headline gets subsumed. In other words, the uplift, excuse the pun, in terms of number, in terms of, oh, that was instant, in terms of actual rides booked and the margins there, but it got subsumed. Having to go on a call and say, whoops, I did it again. It's a Brittany.
Yeah, ooh, nice. But it's the most read story on the Bloomberg terminal this morning. Great. Not that they had good earnings, but that they added an extra zero to their margin outlook.
Yeah, well, go back and watch the Dan Ives interview on Bloomberg Go, and you can pick up what he had to say. Bond markets, I mean, it was a rabid day yesterday for the Burrs, really. Up 13.5 basis points on the 10s. What were the 2s? The 2s were a little bit, that's German.
Nearly 18.5 basis points on the front end. So we did have some of that bear flattening going on. Still, though, headed for the longest inversion on record.
She likes that stat. The longest inversion on record is still this economy remains resilient, it remains strong.
Yeah, but Ella Hoya says that the no landing scenario, she thinks that's unlikely. Still 20 to 30% chance we can have a recession.
Correct, 20 to 30% chance of a recession. And she's not an inflationista, and she likes a little bit of yen. She's going to buy that. That wasn't a bad show today. A little bit of Canadian oil policy and Lyft.
And a little bit of fashion, too. Be it Dan's jacket or your ski boots. So I'd say, covered it all.
The shape of the On athletic shoe is unique. It can't be mistaken for any other brand. The structure of On's C-suite is just as distinctive, starting at the top with a pair of CEOs.
What we realized very early on is if you're adding different capabilities to each other and you do that as equals, then this leads to better outcomes.
Mark Maurer joined On as Chief Operating Officer in March 2013. Martin Hoffmann arrived as CFO that July. In 2021, they jointly assumed the CEO role.
We are a brand that needs to be excellent in designing product, in innovating product, but also in shipping millions of parcels from A to B in the most efficient way. So we need to have very different mindsets and very diverse people. Mark has different strengths, I have different strengths, and if you take us together, you just get more.
Companies with co-CEOs are rare, but On's configuration is even more unusual. Martin Hoffmann also holds the CFO position. He says his two jobs complement each other.
I actually feel the CFO makes you a better CEO, and the CEO makes you a better CFO. Understanding what you build as a CEO helps you to understand your numbers, and understanding the numbers helps you what are the right things to build.
Why do the biggest names in business choose Bloomberg?
That is a great question.
It's a great question.
Great question.
Great question.
That's a question I get all night.
Bloomberg, top experts, great questions.
The depth and breadth has surprised economists and guests across the board, and it's a much more resilient economy.
The consumer hangover eventually will come, but we're not seeing any signs of it yet.
When you look at the health of the market, I think you still have to argue it's pretty broad.
The ability for equities to go considerably higher as earnings become clear is what we have to focus on.
For the equity markets, the important thing is this soft landing is continuing.
This is Bloomberg Surveillance with Jonathan Farrell, Lisa Abramowitz, and Anne-Marie Hordern.
Live from New York City for our audience worldwide. Good morning, good morning. This is Bloomberg Surveillance alongside Lisa Abramowitz together with Anne-Marie Hordern. I'm Jonathan Farrell. Your equity market is bouncing back by 0.4% on the S&P 500. We begin this morning by talking about a single name in the pre-market, Lyft. Now picture this. You've spent hours, days going over your earnings report, and then you release it and you say margins are going to increase 500 basis points. The stock surges 67%. You get on the call and go, oops, I meant 50, Bramo, not 500.
So here's the question. First of all, is this just Lyft being a rather peculiar company that has a reputation of doing things in its own bespoke ways, or is this something that's more nefarious? A lot of people saying a clerical error is not necessarily securities fraud. Can you imagine if you were on the other side of this, though?
If you were short?
Exactly. Given
Brutal.
that. Yes. So,
brutal. The stock is still up by 17%. The numbers were actually quite good. If you go through the analyst reports, they're talking more about the results themselves than they are the shocker of saying 500 when you meant 50.
That's the difficulty here. They actually did really well. They included projected earnings as much as 11% higher than expectations. This is good to report. Why would they have to muddy it up with something that is so distracting and really just stealing the headlines with unnecessary sort of dismay?
And no idea what the counterfactual is. I know it's a pointless exercise, but it's worth a couple of seconds. Where would the stock be this morning without that taking place yesterday afternoon, yesterday evening?
Up 21%.
Is that the call?
I don't know. It would be higher. I think that you're right. It would be higher because although, you got to wonder what management is doing if they allow this to go through. And so it raises some extra questions that they just didn't need.
350 basis points higher than where we are right now. Just to be clear, just to get that clear. No extra zeros here whatsoever. Let's turn to the broader market. Bond yields yesterday higher, much higher. The 2-year this morning, 460. Lisa, we need to talk about inflation. Inflation yesterday, a hot CPI report, might not be enough to derail the story the Fed is telling, but it certainly chips away at the story this market was priced for.
I love some of the commentary. I think Julia and Emmanuel at Evercore ISI, one, saying Goldilocks in the first gut punch, excuse me, basically talking about how everyone was talking about soft landing. The narrative starts to shift to that hot landing type of scenario or no landing that Stuart Kaiser was talking about. And you see the market, and you see all these analysts pushing back their expectations for rate cuts and talking about how the broadening out of inflation is exactly the wrong thing that the Fed wants to see. So now they want to hear Fed officials push back and say it's seasonal, it's one-off, which they don't think that they will.
That's the side of the Fed, but this also had political ramifications because you have all these basic categories going up: food, dining out, energy bills when it comes to electricity. What struck me is that the gem in this report was something that was dogging the administration a few summers ago, and that was the fact that gasoline prices are lower. Can you imagine, though, if gasoline prices were to start to take in some of that risk or something bigger happened in terms of the conflict in the Middle East?
Expectations were pretty elevated coming into the year that maybe all of this would fade away and fade quickly. The Bank of America Fund Manager Survey, which we talked about yesterday, just listen to this. The most optimistic global growth in 2 years, magnificent sentiment, they're calling it. Only 7% expected higher pricing pressure. Very, very one-sided, Lisa, going into that report.
Which is a reason why we saw the biggest move, particularly in small caps yesterday, almost 4% decline, which was the biggest going back to June 2022. A real knee-jerk reaction that a lot of people were saying were driven by quants and the shorts and the people who are coming out, who all were one-sided to this soft landing narrative. Here is the rub. Do we see this shift with people coming in and buying who've been talking about how there's an opportunity, but these are just rich stocks? Or do you start to see a more significant narrative shift about the broadening out of inflation pressures, which is exactly the opposite of what the Fed has to see and what the Fed has to do to really counter that?
We've got a bounce this morning. The Russell is up by about 1%. Broader equity futures on the S&P 500 positive here by about 1/3 of 1%. Yields yesterday a whole lot higher this morning, just a little bit lower, down 2 basis points on the 10-year, 428.87. Coming up this hour, Russ Kostrick of BlackRock following yesterday's sell-off, John Lieber of Eurasia Group with a standoff in the House over aid to Israel and Ukraine, and Sarah Wolf of Morgan Stanley on the state of the economy and retail sales coming later this week. We begin with our top story, coming off the back of a sell-off in both stocks and bonds. Traders pushing back Fed rate cut bets following a hot CPI report. Russ Kostrick of BlackRock holding on to June, saying this: the CPI print illustrates while inflation is decelerating, it will not be a straight path. We continue to believe that June is the most likely month for the Fed to begin cutting. We expect 3 rather than 4 to 5 cuts this year. Russ, I'm pleased to say, joined us now. So Russ, let's talk about the data. Let's build on yesterday, this morning. Is that enough to derail the Goldilocks soft landing hopes and dreams of 2024?
Well, good morning, Jonathan. I don't think so. The number was a bit hot. Just to remind everybody, we were expecting 0.3 on core. We got 0.39. Clearly the wrong direction, but there is some estimation error around this. And I think the broader issue is inflation is heading lower, but there are parts of it on the service side that are sticky. We saw that again on owner equivalent rent. And while it is going to go down, it's not sliding as fast as the market had expected or as quickly as you needed to validate that narrative from late 2023 when the Fed was going to start cutting in March and they were going to cut 7 or 8 times. We still think the Fed will begin cutting late this spring or in the summer. We still think 3, maybe 4 cuts are likely. But again, it's just not going to be a straight line. There are going to be months where you get a little bit of a backup. So I don't think the narrative changes. But again, taking some air out of that sort of high expectation we had back in late 2023.
Russ, let's take stock, though, of where the economic mix is at the moment. Output data, the economy a little bit hotter than we thought it would be. Maybe shelter inflation a little bit stickier as well. When you look at that as a mix for the time being, is that bad for both stocks and bonds or better for one versus the other?
Well, I think it's better for stocks, is the short answer. I mean, obviously, yesterday was a tough number for the bond market. It reacted as you'd expect it to. Stocks took their cue from bonds. But, the flip side of this is we have an economy that, let's say we get 2.5% inflation in 2024, and we get another 2% growth, which might even be on the low side. If you've got 4.5% nominal GDP, there's a decent shot that earnings estimates are probably a bit too low, and we're actually going to beat that. So I think that despite yesterday's action in the stock market, it's probably going to be a decent year for U.S. equities. We can probably put another 6, 7, 8% on what we've already done year to date, and there's reason to stay long equities.
Well, this really raises a question of which equities, in particular, because some of the more cyclically exposed stocks, and I'm thinking particularly small caps, have gotten more and more beaten up the more people push back their expectations for rate cuts. When does that stop?
Well, I think it's why small caps are getting beat up. You know, last year you had this beta-driven rally in November and December after a tough late summer and fall, and small caps benefited. I think the problem for small caps right now, it's an odd point in the cycle to get long small caps. The quality is much lower than the large and the mega caps. And as we saw again yesterday, they are rate sensitive. So if we have an environment where rates are not falling as quickly as the market believed, small caps, early growth, you know, these parts of the market are sensitive. So I think the short answer to your question is what we're doing, we're barbelling the portfolio. We're still long many of the mega cap tech names that are high in quality. We think benefit from long-term secular themes. And we're also long higher quality cyclicals. There's still a lot of parts of the market in airlines, in autos, and parts of the consumer sector and healthcare that are actually pretty cheap, despite, you know, the premium that the market trades at. Large parts of the market were left behind last year, and there is some value there.
How underweight bonds are you? Because you do see that as sort of the underperforming sector in a scenario that you just put out there.
Yes, we are still a little bit underweight bonds. You know, in our main fund, you know, call it maybe half a year relative to our benchmark. So we have been cautious. We do think that spread assets still look good. You can carry in the portfolio well, something you probably have not been able to say for 15 years. But the long end of the curve in particular, we've remained cautious. Part of it is, you know, the over-optimism about when the Fed's going to cut and how much. And the other part of that is supply. We're still in an environment where you've got a significant amount of supply with some of the actors backing away in terms of who's buying that. So still a bit underweight bonds, again, with most of that underweight concentrated on the long end of the Treasury curve.
Begs the question, Russ, when do you start getting interested? 450, 475, you waiting for 5% again?
You know, I think it's a good question. I don't think, you know, 450, I mean, again, it's always dependent upon the context. And obviously, if you're printing hot on inflation, you know, that number goes up. But, you know, as a rough estimate, yeah, I think if you got to 450, it starts to get bit more interesting because we do think inflation is heading down. We do think you're going to see core inflation probably in the 2 to 2.5% range by the end of the year. So if the market gives you an opportunity and you're seeing 450, then I do think it becomes a bit more interesting relative to where we were a couple of months ago.
Russ, what do you do on a day like today, or a day like yesterday, I should say? Are you the kind of person that says, okay, a sell-off, this is a dip, it's viable? Or are you the kind of person that says, you know what, we have our allocations, just stay steady and see how things go?
Look, I think the market did give you some opportunities yesterday. I mean, particularly in the morning, the late afternoon, you know, that's a pretty dramatic sell-off. There were parts of the market that, you know, you may want to go back and take a look at. But like, I do think that the narrative did not change yesterday. It reminded us that the path down in inflation is going to be bumpy. It's not a straight line, but we still believe the economy is in good shape and inflation's heading lower. So I think the short answer is you mostly stick to your plan.
Let's talk about your plan with regards to equities and finish on that overweight in equities that you were talking to Lisa about. Is the US still the only game in town?
I don't think it's the only game in town. We actually also have an overweight in Japanese equities, which have been interesting for the first time. And, you know, take your pick, years, decades. But I do think the U.S. is the best game in town, and there are a couple reasons for that. The U.S. is still the most resilient economy. We're seeing that every day with the economic data generally coming in strong. But beyond that, you know, we still like this theme of quality. We like consistency. We like profitability. And we look throughout the world, and we look for companies that have those characteristics. We still find more of them in the United States in tech, in healthcare, and consumer discretionary than anywhere else in the world.
Hey, Russ, got to catch up. Russ Kostrick there of BlackRock. Underweight bonds, overweight equities. Just a final word on Japan. The move in dollar-yen yesterday, that was a 1 percentage point move in yesterday's session against the Japanese yen.
Well, the response from the authorities.
I'm aware.
Some of the recent rapid moves are in line with fundamentals, but some are clearly speculative. I think the latter aren't desirable. That is the Vice Finance Minister for International Affairs for Japan. And the response from markets, show us the action.
What's she going to do about it?
Yeah, exactly.
What's she going to do about it? They're going to hike anytime soon?
I mean, they could talk a lot. People don't think there's going to be any action one way or another until at least 152 per dollar.
Still north of 150, 150.59 on dollar yen this morning. Let's get you an update on stories elsewhere this morning. Here's your Bloomberg Brief. Brief with Danny Berger. Hey, Danny.
Hey, John. Defense Secretary Lloyd Austin has been released from hospital after undergoing a procedure for a bladder problem. The Pentagon says he will work from home until later this week. He had canceled a trip to Brussels to meet with other defense chiefs and will now join virtually this morning. Austin was hospitalized in January following complications from prostate cancer treatment. It sparked furor after he waited days to inform the president and Congress. UniCredit poised to increase its overall bonus pool for last year by about 16%. The Italian lender posted record profit and increased shareholder returns. The average gain per person will be higher because of job cuts in 2023. The increases will be between 9 and 27%, according to sources. It does buck the trend of other European investment banks who are planning to reduce pools after a challenging year for securities units. Democratic Tom Suozzi has won the race to succeed ousted New York Representative George Santos. Suozzi defeated Republican challenger Mazi Pilip, taking 54% of the vote, with 93% of votes counted. The victory flips the seat back to Democrats and narrows the GOP's razor-thin majority in the House to just 6 seats. And that's your Bloomberg Brief. John.
Hey, Danny, thank you. Appreciate the update. AMH, let's talk about this just briefly. Was that really a referendum on the sitting president?
Well, the fact of the matter is, this is a district where immigration became one of the top issues that people were going out to vote from. And I come from just outside this district, and I can tell you it's a long, far cry from the southern border. So when you think about looking at November, if immigration is weighing on Long Island voters, it's going to be a big issue for President Biden. But what Tom Suozzi did was he took it to Biden, saying there was moments in Congress when I served that I went against my party, and saying that he thinks the border should be shut down. So he didn't try to shy away from it, but potentially it's a way you're going to see some Democrats in hard districts actually maybe put some blame on Biden for the border.
Interesting. John Lieber of Eurasia Group, by the way, about 5 minutes away. Up next on this program, aid for Israel and Ukraine forcing a standoff in the House.
I urge Speaker Johnson to bring it to the floor immediately. Immediately. There's no question that the Senate bill was put on the floor in the House of Representatives, it would pass.
That conversation coming up next. Live from New York City this morning. Good morning. This is Bloomberg.
Studios in New York and San Francisco. Our expert hosts have the data and analysis about the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action. 11 a.m. on the East Coast, 8 a.m. in the West. Only on Bloomberg Television. Context changes everything.
Or other authorities.
Could face bigger challenges next.
It was going to keep bringing World Cup. This is a three.
As the economic picture.
Covering the intersections of Hollywood, Silicon Valley, and beyond.
Bouncing back just a touch on the S&P 500, down yesterday by almost 1.4% at the close. Just erasing some of those losses towards the end of the day. This morning, futures are positive by a third of 1%. Yields are lower by 2 or 3 basis points, 428.68. Under surveillance this morning, aid for Israel and Ukraine, forcing a standoff in the House.
I urge Speaker Johnson to bring it to the floor immediately. Immediately. There's no question that the Senate bill was put on the floor in the House of Representatives, it would pass. It would pass. So I call on the Speaker to let the full House speak its mind and not allow a minority of most extreme voices in the House to block this bill even from being voted on. This is a critical act for the House to move.
Here's the latest this morning. The White House urging Speaker Mike Johnson to bring a $96 billion foreign aid package to the floor. The bill facing a tough audience in the Republican-led House, where border security remains the priority. Johnson writing, quote, House Republicans were crystal clear from the very beginning. Any so-called national security supplemental legislation must recognize that national security begins at our own border. John Lieber of Eurasia Group joins us now for more. John, we've been talking about this now for weeks. The House can pass one bill, the Senate can pass another. Are they going to pass the same bill anytime soon?
Eventually, they're going to have to, but that bill may not include anything they've already been working on. They've got to do this government shutdown bill on March 8th. And if they don't, they're going to have a much bigger problem a political problem on their hand than either the tax bill or the Ukraine aid bill that they've already passed. That March 8th deadline is a really key one that we're watching to see what can get done here. I would anticipate the House is going to attempt to add their tax bill to the appropriations bill that has to get done. But the Ukraine aid, the House clearly has no intention of doing anything on and seems to be operating on a very different timeline, which means we could be in the middle of March still talking about this issue.
Well, could the foreign aid also be attached to those spending appropriation bills?
It could, but there's a bit of a chicken and egg problem because the House has to go first on the appropriations bills, most likely, and it's extremely unlikely that they're going to be the ones who attach the Ukraine aid, which means the bill would go over to the Senate, where the Senate could potentially, we know they have the votes, attach it to the appropriations bill, send it back over to the House, but then you're in a situation where Democrats and Ukraine supporters are risking a government shutdown by trying to jam the House at the last minute. And so far, they haven't been willing to do that. They could have done that in December, and they decided not to.
Yesterday, Hakeem Jeffries says there's more than 300 bipartisan votes for this foreign aid package. I know it's very early in the morning to try to even think this could happen, but could we see a discharge position on the House of Representatives floor?
I think the discharge petition is an extremely high degree of difficulty to get done. I mean, you've got timing issues. There's only really 2 days a month when you can vote on this thing. You've got to make sure you've got unanimous Democratic support, which you may not get if there's aid to Israel that's attached to the bill. And you've got to find enough Republicans who are willing to buck Speaker Johnson, who right now looks very weak, in order to get this done. It's just, this is a very, very narrow path. And it's really unclear to me that they even have the ability to do so. So right now, that's not my expectation. I think that the appropriations bill is a much more likely path. And if that doesn't work out, then, Johnson yesterday was talking about the House working its will, which is normally code for putting something on the floor and then trying to amend it. We're not really sure what he's thinking yet, though.
John, I got to say, yesterday I was wondering why Senate Republicans would put themselves on the line if they knew it was dead in the water going to the House and would go against certain members of their base. Do you have an explanation?
I think the tact is, live to fight another day. And that's all they're trying to do, muscle this thing through the Senate, demonstrate that there's bipartisan support. To Leader McConnell's credit, the vote did grow. And then you had 22 Republicans in support of the measure in the Senate, which is a signal that enough Republicans do support it to pass it in the House. But now the ball is in Johnson's court, and that's really out of the Senate's control.
We're all trying to look forward to see when we can get out of this political dysfunction that feels like it has reached a new level. Tom Suozzi of Long Island did win that election, taking over for Republican George Santos. He is a Democrat. This is what he was saying in his victory speech. The people of Queens and Long Island are sick and tired of political bickering. They want us to come together and solve problems. Is that representative of a way that people can win, or is this representative of Long Island that just ditched George Santos?
Yeah, look, it's very typical for a member of Congress to say that voters want problem solvers. There's even a problem solver caucus in both the House and the Senate, but it doesn't actually do anything to break through the political gridlock that the U.S. faces. I mean, you're nominating a very extreme candidate on the Republican side, and a very old candidate on the Democratic side, neither of whom seem really well positioned to reach across the aisle and solve problems right now. So I think it's really telling when you look at the State of the Union and you've got, you know, Democrats who bash President Trump and yet hurry down to the floor to take a picture next to him. The appearance of bipartisanship seems to be more important than actually coming together and solving problems and agreeing on policy solutions in Washington.
John, can we talk about President Biden just a little bit as well? There were reports that Biden called the Israeli leader an a-hole on 3 separate occasions. And then there was another report in Axios yesterday summarizing a meeting that took place maybe 12 months ago about how angry the president was with his team over the border. This feels strategic. I don't know whether it is or isn't, but it feels like it is. Is angry Biden part of the campaign now for the next 9 months?
Yeah, I think if Biden doesn't look like he's angry about what's going on in the country, he's going to look like he's out of touch, because you got a lot of voters that are really angry with, you know, continued high prices, the situation on the border, and kind of the chaos globally. So I completely agree. These are strategic leaks. The Biden administration is moving to shore up its left flank everywhere it can. It's one of the reasons they started to put conditions on aid to Israel before the vote in the Senate, because they want to make sure that people know they get the message that their stance on Israel has not been popular with their base, and they know that immigration is the biggest vulnerability for them in their reelection. So they got to start doing more on this topic throughout the rest of the campaign.
Immigration is. I was actually struck by how much it played in a role with the ad spending and how much they were talking about it in a district on Long Island. So if immigration is Biden's #1 concern right now, and he's trying to shore up independence going into November, what can he do in terms of executive action to look like he is at least acting tough on the border?
He's a little limited here because he's got the same problem he has in Israel, where he could do something, but he's going to start to lose the left flank because they think that a lot of the actions that, for example, President Trump took were inhumane. So, you know, things like Title 42, which allowed Trump to expel asylum seekers back to Mexico immediately, these things are just not really on the table for him. Republicans did hand Biden a bit of a gift. We talked about this last week when they denied the border bill that Biden was willing to sign, because now he can say, I tried to get something done. The Republicans refused. But you're going to see him start to probably put more resources down there and instruct DHS to do more to export people and give clearer messages to migrants coming over the southern border that they aren't welcome. But he is a little bit limited in the terms of the tools, not because he doesn't have the actual processes, but by the politics of it.
Hey, John, thank you. John Lieber there of Eurasia Group. Appreciate your time. AMH, I wonder what you thought of that read, that write-up from Axios yesterday about a meeting that's taken place in the last 12 months that, just so everyone knows, the president was furious with his team and then didn't change any personnel whatsoever.
Furious with his team, furious with the fact that there seems to be that no one within the administration, according to this Axios report, wants to actually own the border. So it does seem to be like some people are coming in and out of trying to solve this problem. But to your point, you know, we do see the campaign lean on Doc Brandon a lot, you know, with those laser beam eyes. And I never thought of this idea of angry Biden, but
Angry
potentially
Biden
dark.
seems to be strategic. Don't you see the same thing?
How do you express your dislike of something without changing policy? How do you end up trying to seem fired up and ready to go?
Without changing personnel?
Without changing personnel. You try to shift your stance to some level, right? I mean, this raises this question of where some of the communications people are. I mean, really, the Instagram post with the, I like chip cookies.
I know, to see Jon Stewart, what he did with that.
But
Brutal, brutal.
But even worse, it wasn't Instagram, it was TikTok.
All right, thank you.
Which is under CFIUS review, and you have members of his own party in Congress saying, I'm not going to tell the president how to campaign, but that does unnerve me.
We're not going to do a Super Bowl interview, but we'll do a TikTok video about how much he likes cookies. I mean, like, I just can't.
I mean, Jon
I
Stewart.
can't with that.
Cookies. That was great.
People are upset with Jon Stewart. I hope that Jon Stewart actually makes fun of both sides throughout the whole campaign. I hope this is what he does all year.
I think that he's pretty committed to it, as he said. It's
hope
not
so.
just the day of the election, it's the day after.
Equity futures right now on the S&P. Up next, what a difference an extra zero makes. It's lift just around a corner.
think this will probably go down in history as one of, if not the largest financial crimes ever.
I cannot imagine a scenario where $8 billion just disappears.
Bankman-Fried has pled not guilty to multiple fraud charges.
Sam was just too important in the crypto community.
When someone says, I'm going to give $1 billion in the next 2 years, like that catches everybody's attention.
As time went on, their ideas got like weirder and weirder.
I don't think he even had almost a conception at some point that it was wrong or right. I think he just had the mentality that he has to win.
This committee will not stop until we uncover the full truth behind the collapse of FTX.
So, Mark.
Are you in? I'm in.
I'm in.
We're in. Will this be the last of its kind? No. This is the nature of capitalism. Get over it.
Welcome to the world of decentralized finance.
You can see the massive gains for the OG crypto coin.
The breakout we have all perhaps long awaited finally realized. We'll see if it sticks.
Bloomberg's covering all things crypto, the people.
There's no question this industry is composed of some bad actors and some good actors.
The transactions.
Volumes have surpassed $24 billion per day.
And the technology.
Stop talking about the technology. Start demonstrating the utility.
Bloomberg Crypto, Tuesdays.
Bouncing back from the biggest one-day loss on the S&P 500 in about 2 weeks. Equity futures right now positive by 0.4%. The hot inflation print enough to upset the latest fairy tale on Wall Street. The bears have returned and Goldilocks was still there. Do you like that, Bramo?
Oh, that was good. I like
Thank
also
you.
Goldilocks and the first gut punch. I'm going to keep
I like
going
that
back
too
to
from
that.
Julian Emmanuel.
Oh, so
as
good.
well. That's
yeah.
great.
It's just basically, you know, the reality check to the fairy tale you all think you're living in.
Sort of derailed things just a little bit for a moment. Let's turn to the bond market. 2-year, 10-year, 30-year. We had a double-digit move across the curve. About 2-year out to 10-year. This morning lower by a couple of basis points, 429.66. On the 2-year, Lisa, we're back in the 460s. On a 2-year, when there was all this talk of dropping sustainably below 4%.
It wasn't just sort of lip service or a market move. You also see a lot of strategists coming out and reducing some of the rate cut expectations. The bottom line is, this was bad on every level. The super core metrics that the Fed loves rose the most going back almost 2 years. I mean, this is not what they want to be seeing at a time where they're hoping for a broadening out of disinflation, not a broadening out of inflation.
We'll talk to Sarah Wolf of Morgan Stanley in a moment. I think we need to compare and contrast CPI with PCE and the weightings on shouts for one and not the other, and how derailed this might be for the Federal Reserve. You and I said right after the number came out that maybe this changes things more for the market than it does for Fed officials, given the guidance they've given us over the last few weeks.
They can stick to what they've been saying, and frankly, nothing really changes. They've been talking about 3 rate cuts. The market was talking something like 5 or 6. Now people are talking, I mean, I was looking at Carl Cardano over at BNP, for example. He changed his recommendation, or he changed his expectation for this year, pushing it back and having fewer rate cuts simply because of this broadening out in inflation pressures. Yes, PCE will be more important, but the bottom line is, this doesn't make them confident.
Let's turn to foreign exchange. Dollar a whole lot stronger off the back of that bond move. The euro sub 107, 106.98. This from the ECB this morning. Roses are red, violets are blue. We're nearing our target and we will reach 2. Did you see that? This is what they tweeted. I love this from Michael Brown. I'm not going to use his language. I'll adjust some of his language. Roses are red, violets are blue. We messed up the last cycle and we will this cycle too. Well, that's the comeback to the ECB this morning.
All I can say is happy Valentine's Day to everybody for these wonderful poems. I am curious how they plan to message this, given the fact that they're seeing more weakness. We also heard from Luis de Guindos, the vice president of the ECB, coming out and saying that we're not ready to start cutting rates and blah, blah, blah. And people are like, whatever, you know, good luck with that.
Well, Fed officials, ECB officials, BOJ officials too, have all got something to say. Dollar yen, 150.64. There's just a feeling, Lisa, and there's always just a feeling in markets sometimes. Sometimes there's something to it, other times there isn't. 150 feels like this line in the sand for BOJ officials to come out and say, yeah, enough, you've had your fun, we don't like it here.
But is it the line in the sand for them to actually say, okay, now we're going to do something about it?
Yeah, that's different.
Because it seems like, yeah, they're going to come out and say it, and everyone's like, all right, yep, we've heard this before, and then they keep on selling. But here's the question. When do they actually pull the trigger on something more meaningful? And when do they actually have to raise rates or stop some of the bond buying or do some of the incredible financial repression that has taken that country?
Words need to be credible. They need to be credible. And if you're going to keep on saying it, at some point you need to do something. That rate hike conversation has got to grow in the weeks and months to come.
Otherwise, you're going to see more of the same. And that's, I think, what you're seeing right now in the market.
150.63 on dollar yen. Under surveillance this morning, Fed speak on deck after yesterday's inflation data. Chicago Fed President Austin Goolsbee, Vice Chair for Supervision Michael Barr, both speaking today with more data due out later this week. Investors looking to retail sales tomorrow, PPI and consumer sentiment on Friday. FOMC meeting minutes come out a week from today. Retail sales, the one in focus for me, Lisa. If retail sales holds up, if that's looking really hot, then you go back to that Stuart Kaiser conversation over at Citi. You start to tip the scales back towards overheating and away from soft landing.
You know, Russ Kostridge said that this doesn't shift the narrative.
Not for him.
Not for him. I wonder how many people are starting to say, maybe it doesn't, but I'm starting to look elsewhere. When you take a look at Coca-Cola raising prices by 9%, when you take a look at elsewhere and some of these price pressures that people are absorbing, you have to wonder why people are accepting that and continuing to buy. It's because they have money. And that's where retail spending comes into play. And frankly, this question of just whether it was a sudden repricing in January or whether it's something more lasting.
To be fair to Russ, though, already underweight bonds and
sure,
overweight stocks.
So you got it right, so it doesn't change the narrative.
That's why he feels good. Let's turn to the politics. Democrats picking up a seat in the House. Votes in Queens and Long Island choosing Democrat Tom Suozzi to fill the spot left vacant by ousted Republican George Santos. Suozzi beating Republican opponent Mazi Pilip 53.9% of 46.1%, and 93% of the votes have been counted so far. The race seen by some nationally as a referendum on President Biden and immigration policy. The GOP currently holding a 219 to 212 majority in the House. AMH, that margin gets slimmer.
A lot slimmer. And if you look at the vote that was taking place just before the polls closed in New York, it was the impeachment of Secretary Mayorkas, and they won by the slimmest majority. They won by one vote. And remember, it was deja vu because they already tried to impeach Mayorkas and they didn't have enough votes. Steve Scalise, who's undergoing blood treatment for cancer, came back to take that vote. So this is what you're going to start to see when you try to get through some of these very partisan bills. Everyone's got to be there and show up. The majority they have is so slim.
What was the strategy in this race that you think could possibly carry over to the national race?
So I think there's two things. We can't forget that Tom Suozzi is a known name in this district, and Mazi Pilip was brand new to the scene. And after George Santos, potentially some said, let's go back to what we knew. Santos was a little bit of a chaos in that district, to say the least. But when it comes to the national stage, instead of backing away from immigration and the fact that what we see in our polling is that most voters lay the blame at President Biden for this, he took it on, saying,